Of LVMH versus some of the other luxury names play in its favor or against it for the sector? I don't actually know.
We'll see. It clearly isn't caring, I think, is the point that a lot of people are making this morning. Gilts are about to open as well.
Yes.
It'll be interesting to see how they trade on the back of the data we've had this morning, so we'll get a trade on that. Early bond trade out of the rest of Europe indicates actually yields are heading maybe a little bit lower. So here we go. European equity markets are about to open. We're getting the early indications coming through right now. It looks like some of getting a little bit of a hangover from yesterday. So Novo is continuing to weaken today, which is interesting. Infineon looks like it's a little soft as well. That feels like it's maybe an ASML read-through. But look at that. Immerse, the big gainer this morning, up by over 2%. So some kind of effect coming through from the LVMH story. Immerse reports in a few days' time. I think it's next week we're going to get a report from them. They feel like they're best positioned right now. And maybe there's a read across kind of in the sort of the leather goods, etc. trade out of LVMH.
Yeah, and let's bring it back to the miners as well, because you are seeing some pretty big moves there. Your biggest index contributor is going to be Rio Tinto on the FTSE 100 this morning, higher by about 1.3%. But it's kind of a it's kind of a little bit of an anomaly, a little bit of a lone wolf this morning, because when you look at the downside, that's where all of your commodity names are trading. Your Shells, your BPs, your Glencores, they are all down alongside the banks as well. So it feels like cyclical seems to be on the back foot today, unless you look at the likes of even Rio Tinto or even Unilever, for example, outperforming this morning.
A little bit of safety. People like that trade. That's been the area that has underperformed, as we've seen European stocks do so well recently.
Yeah.
It's been some of those food names, some of those sort of consumer names that have not done so well. So ASML, here we go. Let's kind of recap what we're seeing here this morning. Yeah. ASML is down by 6%. LVMH is up by 2.5%. Those are the two of the big stocks that we've been watching out for so carefully. I also just want to check in and show you what is happening with the bond market story this morning. So actually, it's interesting. Let me just track across here and make sure I'm getting the right number. Yeah, gilts. Now we're on a 10-year. We're at 4.3 now, 4.31 on a UK 10-year. So there's a trade there that is obviously having to factor in yesterday's data and today's data, but yields tracking higher in the UK. Kind of, it's a more flattish picture in the rest of Europe.
I mean, this is we're finally starting to see some syncing up between the bond market and the FX market. And this has been a notable divergence that we have seen in the FX space, which is kind of not doing much of anything lately, despite seeing these interest rate differentials pop in higher and higher. And I think that's really important that you're starting to see this convergence this morning. Does this set the tone for a broader trade? And then, to your point, if you start to see the strength come back in cable, is that just more downside for the FTSE?
Yeah, in theory, mechanically, it probably should be. Andrew Bailey was talking about this yesterday, so let's hear exactly what he had to say. He's in Washington, obviously, for the meetings that are taking place there. This is what the governor of the Bank of England had to say on inflation yesterday.
I think the dynamics of inflation are rather different between Europe, and I mean Europe geographically now, and the US. I think there's more demand-led inflation, probably pressure, and a bit more in demand-led inflation pressure in the US than we're seeing. So I think the inflation dynamics are different. We're still seeing the extension of the process of coming out of the big supply shocks that we had, the impact of the war, the impact of coming out of COVID.
The Bank of England Governor Andrew Bailey, they're speaking at the IMF World Bank spring meetings in Washington, D.C. Let's get a little bit more context this morning. Joining us now, Emma Wall, investment research and analysis, at Hargreaves Lansdown, joins us on set. Welcome. Good morning. Let's talk a little bit about this policy story, because since we heard those comments, we've also heard comments from Chair Powell. We've seen the inflation data come out in the UK this morning. Does this set the UK and the US on a closer path than we thought 24 hours ago?
I'm not sure it does. I mean, looking just at this single figure, yes, it came up higher than expected, but it's still a downward trend. And taking that into consideration with the comments from both of those from the Bank of England governor and from Powell, I think actually we are beginning to see the separation between US policy and UK policy. And of course, the big question is how much of a separation, though, right? Because they will be just as aware as we are here about some of the dangers in being too different in their policy approach.
Yep.
But I do think that there is a timing issue here, and we are going to see the UK and potentially Europe move before we see the US move.
What does the inflation story look like, though? Is this being kind of similar to the U.S. in that it's being generated domestically, or is kind of imported inflation a bigger fear?
I think it is the UK, and we have heard that all along. The UK and the inflation shocks that the UK have felt really go back to the war. Some of them go back even to the pandemic, which is a very different story from the US consumer, which is in rude health, right? The US economy is doing very well. So yes, they both are battling with inflation on both sides of the pond, but actually the drivers of inflation are quite different. So that then becomes the way that you tackle that inflation then becomes quite different because, of course, if the UK moves too far ahead in cutting rates, then the US bond market looks extremely attractive. Money flows towards the US bond market, sterling comes down, and then you have that issue of actually you're importing inflation again. So by trying to solve or take the gains of the initiatives that have brought inflation down, potentially then you create a secondary inflation issue.
What do I do with this if I'm an investor? I'm sitting in cash right now. I've got decent yield at the front end. I'm looking further out, and I'm looking at yields that I'm getting 5, 10-year gilts. Do I lock that in right now? Am I going to get bigger gains right now? What are the implications for my equity portfolio off the back of that?
Well, I'm quite cautious. I mean, I've always said that I prefer to be early than late on a trade. And I think bonds are looking really attractive. Not that long ago, in order to get these kind of yields, you had to go to EMD, you had to go to high yield, you had to go to stuff that's pretty sex and violence, right? But here you can get them from gilts. You can get them from T-bonds. Like, why wouldn't you lock in this income now with the knowledge that actually you get growth in the future? It may not be in the next month, it may not be in the next 6 months, but actually longer term, locking in...
Is there a better entry point, though, I think is the question that a lot of people are asking themselves.
It's difficult, but I'd rather be early. Yields may go higher than this because there will be some sort of shock piece of data. There will be some sort of, one of the members of the MPC could say something, or the vote could be split. But you are being rewarded for pretty good income. Inflation is coming down. This is a real rate of return. Now, of course, it's not the only trade. Fixed income is really attractive right now, and one we are encouraging our clients to move towards and move away from the sort of almost singular story that they've been experiencing over the last 18 months of US equities, and to be fair, more recently, Indian equities as well. This is a diversifier, right? Let's get some income into portfolios. Let's diversify some of your risks in a portfolio. And then we're looking to some undervalued of the markets. But if I had to prioritize right now one trade, I'd say lock in some yield.
When does that flip, though? Does that flip at the first rate cut that we see materialize? Does that flip in 9 months in advance of the market pricing? When's the spook factor where that trade is no longer worth it?
I think it really depends on how much forward guidance central bankers give us, right? So if that first cut comes and they don't do a lot of narrative around it, which I expect they will, about where we expect the cuts to come from here. So is this the first of many? Is it cut and then pause for some time? A lot of that narrative will really drive the market. And a lot of that narrative, as we know, often comes even before they make that cut. So I think we'll be looking really closely at the data, but listening really carefully to those central bankers too.
In terms of what I do, therefore, with equities off the back of this, as you say, your clients have been heavily overweight into US equities. As US yields move higher, does that trade struggle? What are you advising them in terms of what to do with that positioning? Is now time to take a profit? If we do get a dip, do I buy the dip? Am I front foot or back foot?
I think the US market has defied all forecasts in terms of we're at the high of the last sort of 5 years, really. And, you see even inflation data last week, the bond market really reacted, but US equities didn't. Now, of course, it's come off a bit this week. I think it has to remain a core part of your portfolio. We're not saying sell out of the US, right? What we're saying is take some gains and put those gains elsewhere. I do think the US market has got further to go. It's just a juggernaut, and it's got some great companies
elsewhere
in it.
means other equity markets, or elsewhere means the bond markets?
I think the number one trade I'd say right now is fixed income, but coming up from that, we do still think there's great value to be had in UK equities. And also, if you can stomach the volatility, Asian equities, in particular China, so much of that bad news is baked in. Of course, economic growth is looking challenged on a 5-10-year view, particularly when we're talking to people about building their pension portfolios here, right? These are multi-decade trades. We do think this is potentially a really interesting entry point for China.
Okay, let's talk about this 5 to 10 year trade then. Where does commodities fit into this? You still have major Wall Street banks saying that the super cycle is just kicking off, and we're already seeing, I mean, oil is a great kind of standpoint right now, just shy of $90 a barrel. Where does commodities fit in that longer term portfolio?
And I'd add gold to that mix as well, right? Because gold has traditionally been a perceived safe haven, and it has provided some, portfolio diversification, particularly in inflationary periods. But it's also becoming quite an interesting metals in terms of a lot of technological innovation, gold and precious metals. So I think commodities are interesting entry point. Gold has done well, but we think it holds and climbs from here. So that's another thing that we're talking to our clients about, particularly we all have clients at different ages and different points in their investment cycle, right? But particularly for those people who are looking more at capital preservation and looking to dampen volatility, gold is really interesting right now.
But is it one that you buy at this level, where it hit record highs this week, 2,400? Do you buy it here? Do you wait for it to retrace a little?
I do think yes, it has hit record highs, but I do think because of things like issues in the Middle East, which unfortunately don't look like they're going away anytime soon, because of greater volatility in the market, because Bitcoin remains a real unknown as a kind of diversifier away from the traditional markets. I do think gold's still potentially on a long-term view. And also don't forget, it's not just about generating alpha from here. It's about providing some portfolio dampening when you have that volatility.
Let's kind of go back to the beginning. You're talking about a sort of safety trade. Now's the time maybe to switch out of US equities, switch into gilts. Inflation is going to run hotter. What do I need to get in terms of my returns? Kind of, is 5% enough to compound out over the next few years if we are going to see, say, inflation stuck at circa 3%? Am I getting a big enough return? Do I need to introduce... what are you advising clients in terms of the sort of the barbells? Where does the kind of the risky bit, the outperformance bit come from in the universe that you're looking at that just gives me that little bit more, that means I'm sort of getting a little bit more return and I'm outperforming inflation in a slightly better way?
It seems perverse to say, but I do think UK equities are potentially your risky trade just because there's so much negativity priced in there. Yeah. They're a 40% discount to the rest of developed markets. Now, some of that is to do with the fact that obviously the US is on a premium. But if you're looking at stuff that actually could really outperform for you without any of the sort of traditional risks in terms of these are businesses that are, very low leverage, great cash, great dividends, good dividend cover. This potentially is the barbell, actually.
Emma, great to see you. Thanks for stopping by to see us here in London. We really appreciate it. Emma Wall, Head of Investment Research and Analytics over at Hargreaves Lansdowne. Thank you very much indeed. Let's take a look at what we're looking at in terms of the big stocks here in Europe. The Core 6 looks something like this morning. Fairly mixed bag. Novo Nordisk, a little bit of softness there, but we'll park that for the moment. LVMH is the real story on this board, isn't it? Up by over 2% this morning. Some of the auto names, some weakness. Then we get to ASML. That's the kind of story. You got LVMH on the upside. The numbers weren't as bad as anticipated. ASML, despite promising better later this year and next year, there's some negativity around what orders are being booked right now. Schneider's up quite nicely, big loss yesterday, and you need to see that in the context. And where we have seen actually people seeking safety over the last few days has been in the likes of Nestle. It continues to climb today, up by 0.3%. Joe Easton, what else is going on? Let's find out with you.
So I want to take another look at ASML because down 5% at the moment. If that drop holds, it will be the biggest decline since 2022. So a big drop. We can see that stock doesn't tend to move as much as that. Now, that had a decent run recently, partly due to the AI boom and also some hopes of a feed through into the smartphone and PC market potentially rebounding. But some of those orders down 60% in the last quarter of that sector getting hit. Then in terms of fashion, LVMH, better than feared. The numbers weren't great. Lots of declines in certain units and the sales almost half what analysts expected. But the stock gaining around 2%, lifting some peers as well. Hermes and Burberry gaining, but Adidas up 5.3% over in Germany today. Again, it's a stock that's had a bad run. It's down sharply given the Kanye West worries, but that stock rebounding a bit this morning. In terms of the other earnings, Continental, that was a weak one, mainly driven by the margin outlook. The company pretty negative on the European auto market in their statement today. Volvo, this is the Volvo Trucks business. They've got sales out today in autos a bit better than expected, but again, not had a good run recently, so coming up slightly. Just Eat Takeaway, now they are warning of a decline in sales. Some of their gross values in terms of their latest quarter have actually slipped. Food delivery, of course, to keep an eye on Deliveroo and other peers. But in the UK, we've got ASOS gaining around 9%. Now, they have warned recently that there is a bit of a decline in people buying clothing online, but the sales, again, it's kind of the buy the fact, sell the story kind of issue with that one. But we're going to do Borussia Dortmund. I'm very excited. I stayed up very late last night. I'm a bit tired because I was watching that game. Absolutely sensational football match. They went into the game losing 2-1 aggregate, and they come through to beat Atletico Madrid. First Champions League semi-final in 11 years, and the share price is up 9% this morning. They will get an initial payment of 12.5 million euros due to them reaching that stage of the tournament, but it's all about the marketing that comes with the Champions League. So we've got a football mover on the screen. BVB up 9% over in Frankfurt following that Champions League victory. In terms of your ratings changes, Unibail, this is the owner of Westfield. We get an upgrade for them. This one over at City reckons you should be buying that, given valuations are going to start recovering, according to analysts at City, so that one is gaining. Then we've got a bit of DIY. Akzo Nobel, the maker of Dulux paint. It is getting more expensive to paint your house, according to analysts over at Jefferies, but they reckon that that will boost the earnings over at Akzo, and that stock is gaining 2%, as Jefferies recommends buying. €79 price target. It's at 66. Plenty of upside, and that one moving in Amsterdam.
Joe Easton from our equities team, we thank you so much for walking us through it. And I love that Joe talked a little bit about, well, he called it football, but I'm going to go ahead and call it soccer. I love that it trades by 8.8%. I know, but I kind of have to. It's part of my rebellion.
You play with your feet. It's really a kind of, it's fairly simple.
I'm American. I'm rebelling.
I know, where you play with your hands, which is obviously something of a weird concept. Yeah, so Champions League. Sports.
But sports. Did you watch?
No, I didn't stay up late last night and watch the game. Though, yeah, the Barca PSG game looks interesting as well. So
I don't know why I brought it up. All I have to add is sports. So
if you're going to bring it up,
I don't really know why I did that. Let's talk about something I can't talk about, which is LVMH and ASML. I mean, these were both on your sensational six. They are both very polarizing in terms of what they're moving this morning. LVMH, a fairly positive story. You said that Hermes was trading positively off that as well. ASML on the back foot, and I think SAP actually is trading negatively off that as well. They tend to trade neck and neck, just as kind of that big tech trade.
Yeah, it's weird, isn't it? You would like very different businesses. Enterprise software and lithography don't necessarily.
Yeah,
kind of
but
feel
it's like big tech all wrapped into one.
The sector gets hit. There's obviously a kind of basket trade that works around that. I think the reaction to this is quite interesting. LVMH, in some ways, you looked at the numbers, and the initial reaction was quite negative.
Yeah.
But then you kind of look at where they are in terms of the context, and then you look as well about the fact that the comps are really hard. But the comps are hard next quarter as well.
Yeah.
So there's kind of 2 quarters of quite negative comps that are going to be the business is going to work through. If it can survive that negative comp story and get through it into the back half of the year, maybe a more positive picture emerges there.
Maybe, and then in the other kind of moves that we were watching, Rio Tinto also high up on the list, despite some of the other commodities name not moving in tandem. If you look at some of the kind of analysis this morning, it's basically saying that it's just a catch-up trade in Rio Tinto that some of the other names had already dealt with.
I think what's interesting, just to get back to the luxury sector for a moment, there's some really interesting pieces being written. There's one on the terminal this morning talking about the fact that actually higher rates is actually helping the consumer trade. Consumers are looking really strong right now.
Yeah.
Part of that is what is happening with the stock market, which is doing quite so well, but people are making a decent rate of return right now.
Yeah.
And that's giving, if you don't have a mortgage or you've got a very low mortgage and maybe you're retired, the ability to spend at the moment is quite high.
And you mentioned that Unilever was trading higher as well. L'Oreal was one of the top movers. So that's true. There is a theme there that maybe.
Well, I think that to your catch-up trade story, that's much more of a catch-up trade. Yeah. Simon White's written some interesting stuff on the MLive blog as well, talking about which sectors have underperformed. Yeah. And the kind of the food and the Unilever, Nestle end of it has been an underperformer. And he's saying if we're going to see this inflation story catch up, because it will drive their top line, then maybe that's where you start to see some outperformance.
I'm having a lot of deja vu. This is a food commodities-driven inflationary story that ended up becoming your hedge and therefore your outperformers. Coming up, we stick with that theme about inflation being kind of sticky. Data this morning showing that UK inflation coming down more slowly than expected. It's just what Guy and I were talking about around the trade in particular. We're going to dive into the economics next. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Certainly the case that, the feel-good factor as interest rates start to come down, as people start to feel higher real disposable incomes, will be stronger in people's minds come the early autumn than it is now. People have been through a very bruising period. Obviously, decisions about election timing are for the Prime Minister, and were we to have an October election, as I've said before, it would be possible to have a fiscal event in September, but we would decide much nearer the time whether that was the right thing to do.
Well, of course, you've already delivered a lot fiscally in terms of tax cuts, including personal tax cuts, and yet when you look at polls, obviously the Conservative Party is still running significantly behind Labour, I believe by roughly 20 points. What else may need to be done on that front to convince UK voters to keep the Conservatives in power? What would you consider doing?
Well, I'd be very cautious about looking at those polls because, first of all, as we can see from the challenges facing incumbent governments, not just in the UK, but in the US and Germany, France, the electorate have been through a really difficult period with an energy shock, with high inflation, with a pandemic. But when it comes to a general election, it's a choice about the future. It's not a referendum on how you feel right now. And that becomes a very different decision in people's minds.
Kelly Lyons talking to Jeremy Hunt, the UK Chancellor of the Exchequer. October, maybe. We'll see on that election front. Complicating matters this morning, certainly the CPI data that we have seen, suggesting maybe sticky service-side inflation, which may cause the Bank of England maybe to take a more cautious view when it comes to cutting rates. Let's kick this around a bit. Sam Anster joins us on set, as does Dan Hansen. Dan, let me start with you. Your kind of economist take on what numbers we've seen this morning and what does it mean?
Yeah, so, I mean, we just spoke off camera there, but I think a bit disappointing, to be honest. And you've mentioned the services number. That was 0.2 percentage point higher than the bank had in its February forecast. So signs of stickiness there. I mean, I think the broad story with the UK still, even sort of notwithstanding the disappointment today, is that we're going to be at 2% next month, in and around 2%, and we're going to be there for the remainder of this year. And that's a very different story than we had even, say, 6 months ago. Obviously, the surprise today means that the profile might be a little bit higher, but I think when you think about what's driven wages, services, inflation, it's things like energy, it's things like inflation expectations. And if you have lower energy prices or falling energy prices, which is what we're going to get, and if you have lower headline inflation, there is a hope that in time that will feed services inflation and begin to bring it down. But I think the takeaway from this data today, a little bit disappointing, and I think you've picked the right word. It's going to prompt a little bit of caution from the bank, particularly as we go into the May meeting.
Sam, hop in here and talk to us a little bit about the market reaction, because if we're talking about this kind of uptick in inflation and this potential kind of closing the gap between the UK and the US in terms of monetary policy, explain to us what's going on in cable right now.
Well, yes, so the main reaction really has been in the pound this morning. There's a little bit of a reaction in gilts, but quite a lot of the market reaction this morning has been relatively calm. And a lot of that is because it's been front run. You know, previously from last week, we had the inflation data out of the US last week, then the retail sales data. This global narrative started to take hold, and that has kind of priced in a lot of what we wanted to see in gilts. And then the sell-off in stocks yesterday has meant that the FTSE 100, and particularly the FTSE 250, which is much more sensitive to what the Bank of England may or may not do, are not moving a huge amount today. So a lot of that has already been front run. But the pound, as you kind of mentioned, that's where a lot of that reaction is coming. And that's kind of an interesting question, actually, because the dollar has been, very, very strong. It's been, very consistently especially over the course of the last week. So it'd be interesting to see if that holds through the day, particularly as we sort of get more data through.
The Bank of England tiptoed into the rate hiking cycle. Is it going to tiptoe out of the rate hiking cycle? How cautious? Dan talks about caution. How cautious do you think it will be, particularly given where Powell is right now?
Yeah, well, I think as Dan was just sort of saying, like the inflation is moving in the right direction. Yes, services inflation is a concern, right, and that will make them more cautious. But it is moving in the right direction and is going to continue to do so, over the course of the year. So yes, more caution, and certainly the market at the moment thinks much more caution. They've completely priced out the idea of there being two cuts this year. I think that's probably a little bit too far at the moment, and a lot of that is this feeding into this global narrative of rate cuts being pulled back.
Where do you stand on that? Where does Bloomberg Economics stand on that?
Yeah, so I just want to pick up on something Sam said. If you go back to February, when the bank last put out a forecast and the press conference afterwards, they said, if this forecast comes to pass, we think we'll cut rates. Their forecast was consistent with 75 to 100 basis points of rate cuts.
Yeah.
Their forecast may be a touch off track, but it's not miles off track. They were 0.1, we were 0.1 above on the headline, 0.2 above on services. Month to month, you're going to get a bit of volatility. Wages about in line, unemployment higher. So I think, net, they're not going to be making massive revisions to their forecast based on the data we've had. So you think, basically, maybe, as Sam said, one or two hikes might be a little bit too not enough. Cuts, in fact. It may be a little bit more than that.
All right, Dan Hansen from Bloomberg Economics and Sam Unstead from our Markets Today blog walking us through that UK story. And that UK story continues in the 9 a.m. hour with an exclusive interview with Philip Hammond. You're going to have to tune into that. Stick with us. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
This is Markets Today. We're about 30 minutes into the European trading day. When you look at kind of the markets here, it feels a little bit like a single stock story when initially it did feel a little bit more macro. You are seeing the stock 600 in the green by about 0.1%. A couple of movers that you should keep your eyes on, in particular when it comes to the consumer sector, but also the tech sector. Two major trades that you've got to keep your eye on this morning that are going in two very different directions. It really does seem like tech versus consumer as opposed to big cap versus small cap guy.
It's really interesting, isn't it? And how the market is reacting. And I think context is important here, particularly with LVMH. You think about kind of where the comps are and kind of where expectations were coming into this.
Yeah.
There's all kinds of... LVMH is one of the, is such a kind of macro story in so many ways. It tells us so much about what's happening with the consumer. There's a big sort of geopolitical overlay as well. And then there's a kind of sort of geographical overlay that you need to factor into all of this as well. So I think it's a really kind of fascinating story, what's happening with China, what's happening with the European story, how the US stock market is impacting US sales. So I think LVMH has got some really interesting things kind of that you can take away from it today in terms of what's happening.
Yeah, and there's a profit story, of course, at the core of it. Adidas, for example, as well, hitting a two-year high this morning off of that. And then, of course, we have that tech story as well, which, of course, we've talked about all morning long. Let's bring in an expert on the luxury sector here. Carol Maggio joins us right here on set, dressed fabulously, I must say. Head of European luxury goods research over at Barclays Investment Bank. Talk to us about the nuances of what we got out of LVMH.
Yeah, sure. Thank you for having me. So I feel like the print was actually quite not as bad as maybe some people feared, on Q1 LVMH numbers. I guess to start with, fashion leather goods, the core division was just up plus 2%. But, when I speak to investors ahead of the print, I feel like people were still maybe expecting some negative growth to come up in the first quarter update. So I guess plus 2 isn't that bad when you think about it that way. As well, you had some really tough comps when you think about it in the first quarter, which we are still going to see in Q2, to be fair. So I guess we maybe are not out of the woods yet, but I think Q1 kind of reassured because the Chinese were still up, 10%, spending across the globe, mostly in Japan, of course, because of the, pricing advantage on the FX. But yeah, they were quite resilient. And I guess in the other, key market, Europe and US, it was still pretty much the same. So slightly negative, and of course, still the high end driving the growth, while the lower end consumer is still a bit under pressure.
Well, Guy was talking about the comps there, and you bring up the Chinese consumer. It feels like 3 months ago when we had this exact conversation with LVMH, the concern was the Chinese consumer is only weakening from here. Therefore, LVMH can only weaken from here. To what extent does the U.S. and other key regions offset that?
That's a good question. I think that definitely the U.S. can, of course, offset the weakness of the Chinese consumers. But I guess to start with, China is still, again, quite resilient, right? They have been up 10%. And, we are seeing still a Chinese tourist, again, buying more and more abroad, which is, of course, driving the growth. And even though it is quite weak now in mainland China, I think the Chinese tourist is offsetting the weakness of, domestic China sales.
Yeah.
So it's, in a way, it's quite okay. And I guess on the U.S. front, it is, of course, right now still quite a bit weak, as mentioned. But the message also was from the company that maybe, from the upcoming quarters, you could see the entry-level consumers getting better and the higher-end one in America still being quite resilient. So we can also maybe see some improvement in the overall American consumer because the lower-end segments could catch up and get back on track.
There was this expectation coming out of the pandemic that after we saw the spending surge, that we would see a hard landing for luxury. Doesn't look like it's happening. Looks like we're getting some sort of a soft landing. Is this just delaying the hard landing? Ultimately, do we still see maybe consumers pulling back in a much more meaningful way? We're all completely confounded by how strong the consumer has been. But ultimately, is it just a hard landing deferred, or do you think that actually luxury is seeing a soft landing here?
Yeah, I feel like it may be more of a soft landing than a hard landing, to be honest. I feel like, to me, the toughest year is going to be this year, because of the tough comps, because of the macro environment being so weak. So I feel like if we are able to deliver a growth in the sector of, mid-single digits, it's not that bad. So I think, to me, it is clearly a soft landing, and going forward, the trends are likely going to be getting better and better. So I feel like the risk is really here, and if we're able to, face that quite, good way as of now, I think, the risk is pretty much going to be behind us going forward.
What do I want to own in this space? Do I want to own the Immerse because it continues to just deliver and it's a great compounder and it continues to do really nicely? Or do I want to own Burberry? Do I want to own Kering? Because that's where the recovery trade. 2 new designers coming in, yet to really have an impact. If they do have an impact, potentially they could have a big impact. How do I want to think about how I position myself within the space?
Yeah, I feel like, us at Barclays, we're still, I guess, more biased towards the higher quality names in a way. So we tend to push more names like, Hermès, Richemont, LVMH, Moncler. So names, I think, who have a really strong top-line growth already visible at the moment. And I think are also a bit more exposed to this really high-end consumer who is still resilient and doing fine. Of course, the Kering, the Burberrys could be interesting story, but I think it's going to take a lot of time to get there. And, right now we are still in a phase of, I think, earnings downgrade cycle. So, of course, we had Kering just having a kind of soft warning a month ago. So I think we definitely are not out of the woods yet. So, I just want to, wait a bit more here to see the kind of end of the weakness. I think it's too early.
So we broke it down kind of by region and then by competitors as well. Let's break down by product as well, as opposed to take out kind of the clothing design piece out of it. Sephora, for example, versus their wine and spirits business. Where are the divergences you're seeing there? Where are the trade-offs there?
Yeah, I think definitely it's also quite polarized, right, by division at LVMH, to come back on this name. So definitely selective retailing, so Sephora is doing quite strongly in the US especially somehow. So I think definitely they are a key growth driver in the business. And same thing for perfume and cosmetic, also quite resilient for LVMH, and has been the case for a few quarters already. So I think quite strong, definitely. And of course here the laggards have been in Q1, wine and spirit, down like 20%. So of course the US cognac, and I think also Chinese cognac, is still under pressure. So, of course, we have to see how it goes, but I expect a quite soft recovery here. And as well, watch and jewelry also slightly down in the quarter.
I think we're all still waiting to hear when Sephora is going to expand in the UK. At least I am. I'm
quite invested in that trade.
It's one of the first things I did when I moved here. I was like, where's the Sephora? And it was very, very far away, farther than I was willing to commute. But I'll ask one more question about the wine and spirits business here. What is the read-through in the broader kind of sector? We had a series of CEOs come on in the last quarter talking about, again, the consumer resilience in the States driving the wine and spirits business in Europe. You saw that with LVMH. You saw that with Remy Cointreau is the name, I think, as well. You saw that with Heineken. You saw that across the board. How long does that sustain?
That's a good question, which is really hard to, of course, answer. I think the message of the CFO was during the call of last night was maybe they are seeing lower level of inventory now in the US, and they are seeing some maybe signs of stabilization with the US cognac market. So it was, I think, a bit more a hopeful message that maybe we could maybe see the end of the weakness in the cognac business in the US especially. So I feel like maybe by the end of the year we could get back to some more stabilizing growth level, but I think it's going to take time again, and right now it's still quite volatile.
Is LVMH still a China trade story? When we think about, it's been really interesting to watch what Apple has been doing in terms of its positioning around China and the impact that China has had. Is the luxury sector in Europe, is it looking west rather than east now? Is it looking for its growth out of the United States going forward? Has there been a kind of a shift in terms of the mindset? Because in the run-up to the pandemic, China was the trade. If you thought about how you wanted to play China, you thought Europe, you thought I'll play it through the luxury sector, that's kind of how I'm going to make that trade work. When you talk to hedge funds, when you talk to investors, what are they telling you about how they're using LVMH in their portfolio? What does it represent?
Yeah, I feel like, to be honest, it's still quite a big China-focused name, LVMH and the sector, I think, overall. So, of course, yes, it has been during the pandemic a big focus, and the Chinese have, come back on track to start with, and they like become a bit more quieter and weaker. But I feel like this year a kind of key debate is still the Chinese, but now the Chinese tourists. So they're going to come back in Japan, maybe as well in Europe going forward. So we expect them to still drive the growth in the sector, and just how the Chinese consumer is evolving is a key focus still on the luxury sector and of course LVMH. So to me, yes, it is still a China trade.
Carol, nice to see you. Thanks for stopping by.
Likewise.
And seeing us this morning, digesting what we saw yesterday out of LVMH. We get Immerse next week. We're looking forward to seeing what it has to say. Carol Maggio, Head of European Luxury Goods Research, joining us from Barclays. Let's talk about another French firm that we need to have a firm focus on this morning. The CEO of IT firm Atos, which has been struggling with its tumbling share price and, of course, that debt wall, says that he's now confident the French company will be saved. Paul Salah spoke in an exclusive interview with Bloomberg's Caroline Conan, joining us from Paris.
We are actually working with our creditors, both our banks and our bondholders, for a solution to our high level of debt, and the maturities are coming due in the next 18 months. And the dialogue is very, very positive. We're operating under the conciliation, as you have mentioned. It's like a mediator is helping through those discussions. And I do believe that everybody is aligned. In fact, we recently had secured some liquidity from those same bondholders and banks. Again, an indication that everybody is really aligned to find a solution.
So what else could be part of the proposal apart from this group of bondholders? Are we going to see, for example, some asset disposal announced before the end of next week? Is that a possibility, or do you totally exclude this?
I think what we have presented is a comprehensive plan that included all the assets of Atos. Now we're going to have to see what proposals are going to come through. Some of them will just keep the whole of the company together. One of those proposals is likely to come from one of our largest shareholders, and others will come in from our bondholders who seem to also be interested in keeping the whole company. But we can't just really forego any potential proposal that may come in and may entail a different mix of ideas, such as asset disposal or not.
Will this whole plan be able to save Atos?
Actually, Atos is a great company, as I mentioned to you. It just really is going to be, I do believe that we'll come up with a plan and the company will succeed long term.
So it will be saved?
It will be saved.
Paul Salah there, the CEO of Atos, speaking exclusively with our very own Caroline Conan in Paris. Now, coming up on the program, shares in Norwegian defense and aerospace firm Kongsberg have gained more than 60% this year. We're going to talk to the company's defense and aerospace president next. Stick with us. This is Bloomberg.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why It's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep winning World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The tendency of doing research programs for long-term capabilities, and when it comes to sort of manufacturing and industrializing this, we buy outside EU, right? Which is kind of crazy when you think about the return on investment. So of course, I see the balance is wrong. I mean, Europe has to sort of put up industrial capacity also from the research we're doing, and not buying so much outside Europe. I'm not trying to protect sort of my own company or anything. We need competitiveness for sure, but we have to have the whole life cycle of things also with capacity in Europe. That would increase competitiveness.
The Saab CEO talking about the fact that if you are going to spend money in defense, make sure you spend it all the way through the cycle, from R&D all the way through to industrialization, and that'll give you maybe the sustainability to sort of keep that industrial story going over the longer term. It's a key subject that I think a lot in Europe are debating right now. Ultimately, how do you pay for that as well? Which takes us to the summit that is taking place in Brussels right now. Ollie Crook in conversation there with the Saab CEO. We've got another guest right now. Let's carry on the conversation. Ollie, over to you.
Yeah, Guy, as you mentioned, we heard the Saab CEO saying that really predictability is what this business, what this industry needs to get these order flows and really to ramp up that capacity. This is a low volume industry historically, so we're talking to the CEOs who actually need to make this happen. And I'm joined now by one, Erik Lie, who is the president of Kongsberg Defense and Aerospace. I'd like to just start, if I may, just on the recent sort of attack from Iran into Israel. Is this going to boost international spending on defense even more, or is this just part of the same story we've been seeing?
I would say it's part of the same story, but it shows and underlines the necessary of keeping security on top of the priorities.
And so one of the things that we learned from this, I think, is that I found interesting was that, yes, there was a 99% success rate in shooting these drones and rockets out of the sky. The price tag, you know, I think it's hard to report exactly on, but it's close to $600 million. That's $2 million per drone back of the envelope. That is not really sustainable, I suspect, given, you know, the price difference between how much it costs to make a drone and send it. And you're, you know, in this space of air defense. How do you deal with that? How do you get the cost and the systems up to date for the war in 2024?
Yes, so it's a good question. I think it's correct what you're saying, and you have to defend your own territory. Mm-hmm. So you use what you have, but I also think that we could have different solutions to take down cheaper drones in a much more less expensive way.
And those sort of air to surface to air and kind of defensive units, many of your products have gone into Ukraine now. Thinking about the reality, there's a lot of concern that this sort of the engagement is waning a little bit with that. You are looking at the actual order flow. How is that looking? Are there enough systems getting to Ukraine right now? And is the demand where it was before?
I think it's difficult for me to answer if Ukraine have enough. I think they will demand for more.
Certainly.
But we are currently delivering a lot of air defense systems, and we have delivered and donated a lot of air defense systems to Ukraine, and it's heavily used in Ukraine. So we have ongoing contracts. At the same time, we have different solutions, more innovative solutions, to counter this US threat that is much cheaper to take down.
And what are some of those solutions? Just to, because
Yeah, so we used some of our existing system, like our remote weapon systems, combine it with a sensor, and we can take down these cheaper drones in a much less expensive way.
I see, and I think one of the issues that many of the politicians in Brussels are trying to solve is kind of illustrated by perhaps your and many defense companies' backlogs, right, which I understand has increased sixfold from before the war until now, and that shows the discrepancy between demand and supply. How do you get demand and supply to match up, and what do you need from the politicians in Europe and the conversations you're having to make that happen?
Well, first of all, I think what you mentioned up front here was these long-term commitments. That is very important from the government. I think we in Kongsberg, we noticed that there was an increased demand for our products before the Ukraine war. So we actually started to build up capacity for production, both for air defense and missiles. And we take advantage of that in order to meet the demand. And we invest our own money into these facilities so that we can meet the demand. But we see an even more increased demand for this going forward. And this is where we need to discuss with the policy makers and governments in order to secure long-term commitments, long-term contracts.
So one of the constraints is the long-term contracts. Another, when it comes to actually building this stuff, is materials and supply chains, and maybe competing internally within Europe for either between defense companies, but also other industries. What does that look like? And does the government need to step in if you say, hey, we need to prioritize defense to get the materials at the price we need them?
To some extent, that might be true. At the same time, we as an industry need to secure that we have a redundant supply chain so that we are more robust when it comes to get the supplies we need for our products.
And a lot is being made about European competitiveness and trying to boost it and making sure it can compete with, on many industrial issues with China, the United States. Defense is no exception to that. Do you think that something that might help that potentially is looking potentially at M&A within the defense industry to kind of, if Europe is more willing to give certain parts to different countries and different companies?
That might help, but also at the same time establish long-term partnership with the different suppliers in order to secure that they also see a long-term commitment from us as a main provider of products.
And one of the concerns might also be within the EU. Norway is obviously not part of the EU. This is where you guys hail from. There might be a lot more of an impetus to give more support to EU companies from EU budgets and that sort of thing. Is that a concern for you?
Well, Norwegian governments are working very closely with EU, and I think we are very integrated into the defense and security aspect in EU. And we as a company, we have collaboration with many companies within EU, so I would say that we are an integral part of EU industrial base when it comes to defense.
And I want to ask you quickly in terms of the future of warfare and AI. You're dealing with a lot of sensors and mapping battlefields and air defense system. How is that changing how you're thinking about developing new systems?
Well, I think we need to have more innovation into our systems going forward. So more autonomous systems is needed, maybe also boosted with artificial intelligence in a good manner. So I think those aspects are important. In addition, we also see a space segment as more and more important for defense and security.
Eric Lee, thank you so much. That is the CEO of the Aerospace and Defense Unit of Kongsberg, hailing out of Norway. Again, another voice in this conversation from all the CEOs that are assembled here. And just a few meters away, a kilometer away, EU leaders will be meeting later today and tomorrow to discuss, among all of these sorts of things, defense and competitiveness, as well as industrial strategy here in Europe.
Bloomberg's Oliver Crook there walking us through whether or not we see the actual delivering of what we're already seeing getting priced into parts of the stock market. Certainly something we're going to be watching out for. Other things on today's docket, though, at 10 a.m. UK time. Final Euro area CPI. It really comes back to the macroeconomics. 7 p.m. London time. It's all about the Fed's beige book. And later, European Council holding a special meeting in Brussels. And throughout the day, of course, central bank policymakers speaking at events. Christine Lagarde, Andrew Bailey in Washington, D.C. on the tape. Will they diverge from Chair Powell? Take a cue from Chair Powell? Will that move the markets?
How far can they diverge from Chair Powell? Powell kind of confirmed what we already know. Mark was talking about this earlier on. We've already known that the US data is strong. He's kind of confirming what the market already thinks.
Yeah.
The next question is, kind of the market at the moment has quite a lot of rate cuts priced in for both the Bank of England and the ECB. Fewer now, but still, does that divergence still need to maybe kind of compress a little bit?
But also, what are they responding to here?
Yep.
Is growth a good thing? And right now in the U.S., growth is a good thing so far. At least it's being framed that way. It's consumer resilience. It's still being able to pay their debts. It's a little bit of a ramification of stimulus as well. you can't say that about the UK. You can't say that about the EU as well. This is where growth is actually a bad thing.
Inflation was a little hotter this morning, but not by much.
Yeah.
Is it a price worth paying at the moment to get that growth narrative maybe back on track in a slightly more meaningful way? You look at the IMF yesterday downgrading expectations in terms of UK growth, significantly upgrading US growth expectations. A lot of that comes... There is a rate story here, but there's also kind of big fiscal part of that narrative as well. But the UK's hands are tied much more on the fiscal front. Hunt could talk about the fact that he can do things in front of the election, but he can't do that much. Whereas maybe a little bit of a rates boost might help.
We should point out, though, that 2 years ago, the IMF also said that the UK was going to stick in recession for like a 6-year-long recession or something like that.
The forecasting record isn't exactly great.
Yeah, but
it highlights the gap, I think, between... The gap is so big in terms of what their expectations are.
Yeah, but I think that's where, and we're kind of talking about the central bank story with a lot of the developed economies, in that same kind of breath 2 years ago when the IMF had talked about the UK kind of being in this prolonged recessionary period, they'd also said the canary in the coal mine for inflation was in the EM story, that sovereign debt was going to be an issue in the EM space. We haven't seen that materialize either, but now that we're seeing commodity upticks again, it all kind of filters through, but it filters through from the EM story into the developed.
The FX story there, I think, is really interesting as well, is the dollar going to break something soon?
Yeah.
And I think that's a question that I think is increasingly percolating as well as we see this dollar strength, and we continue to see this dollar strength. I know we're getting a little bit of a kind of pause maybe now, but you've seen big records going over the last few days. Central banks, particularly in the EM space, are really struggling to keep up with this and having to defend quite strongly their currencies. Yeah. Does one of them give up? And if one of them gives up, the dominoes start to trickle.
Well, the dominoes are already starting to fall, right? You saw it just this morning in the Asian session. Japanese yen, the weakness has been a story ongoing, but the Korean won is one that we don't pay attention to in terms of currency intervention or in terms of broader global risk. That's a domino effect you're already seeing in the Asian markets. When does it hit, to your point, the EM story, but then also the commodity story as well, at a time when gold is already on this massive run?
Yep. Commodities, what happens with China, how does that commodity story affect the currency narrative? I think what I'm really talking about is something breaking. I'm not talking about them kind of incrementally kind of being pushed further and further out. At some point, maybe something cracks. And I think that in the past, that's had quite a big feedback loop. And that again, we've seen it in the past where it has changed Fed policy. There have been currency crises that have fed back into Fed policy, and we've seen changes on the back of that. Equity markets this morning, two really interesting stories. ASML, I think, is one of them, and the other one is LVMH. ASML down pretty hard. LVMH having a much better day than you would have initially thought, judging by the numbers.
Well, the ASML story, it almost is interesting to me that it's having such kind of a violent stock reaction here, is because the expectation was already that the comps were not going in their favor. You already saw this massive kind of boost that you saw in the fourth quarter anyway. The fact that they missed those estimates anyway, but are really pushing that out to the back half of the year, I'm curious what changes in the back half of the year at a time when their margins are still growing substantially, and at a time when, by the way, we had TSMC numbers just out recently, and their growth is massive. So there is some sort of hiccup in terms of the whatever the opposite of a feedback loop is, but like the ripple effects that you're seeing.
We'll go with that. That sounds like a good one. That wraps things up for Critty and me. Up next, we have The Pulse. Francine is going to be joined by Philip Hammond, the former Chancellor of the Exchequer. We'll get his take on that inflation data that we've seen out of the UK this morning. Looking forward to that conversation. Coming up next on The Pulse, this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our RNI, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Jay Powell signals the Fed will wait longer than previously anticipated to cut rates following a series of surprisingly high inflation readings. Now, the latest CPI numbers in the UK are also stronger than expected on higher fuel prices. We'll talk to the former UK Chancellor, Philip Hammond. Plus, chip machine giant ASML misses estimates on first quarter bookings, but it signals a stronger second half and sticks to its guidance. So we'll talk about chips, we'll talk about some of the technology stocks. You can see this is the mood across the European markets. We're seeing a little bit of a lift, but again, this is after a very difficult week for equities so far. So there's a semblance of calm. I say semblance because it all has to do with dollar, and the question out there on everyone's lips is actually how much pain will the dollar inflict not only on emerging markets, but actually on companies across the board. So you can see Bloomberg US dollar will also show you actually, for example, euro dollar overall, but treasury yields also trading near this narrow range near 2024 highs. So we'll get you some of the treasury yields on the 2 and the 10-year. So Powell's hawkish comments are shaping a lot of today's narrative. So for all of this, let's bring in Lucy Baldwin, Global Head of Research at Citigroup. Lucy, we're lucky to have you on a week. I mean, I feel like everything's fallen out of bed in the last week and a half, right? So it's very clear that there's a function. We look at treasuries, a dollar higher, and equities down. Like, for how much longer are we going to see this divergence?
Yeah, good morning. Great to be here this morning. And yeah, as you say, there's an awful lot happening in markets. And from a macro perspective, quite a lot has changed because, as you say, the data in the US particularly has been incredibly strong. And obviously those expectations of rate cuts have been pushed further and further out. And I think certainly the data that we've had from a CPI perspective, from a retail sales perspective, all of which have led to these comments that we've just had from Powell, that essentially we're going to see those rate cuts starting later than previously expected. And again, even closer to home here in the UK, we've had the UK data coming out this morning again, also really testing even our own narrative. You know, we've expected to see cuts starting in the UK in June. We'd even thought May might have been a live meeting. But this last mile of inflation and getting it under control is really proving to be quite a struggle. And, you know, obviously in the UK example, it's a small open economy. That services inflation really proving very sticky for the Bank of England to see coming down to the levels that they would need to get that comfort to start that cutting cycle, which of course is what markets, as you alluded to, are waiting to see.
Yeah, so when you look actually at the inflation figures, and again, we spoke to the Chancellor yesterday, Andrew Bailey was also speaking at the IMF, so I don't know whether that narrative really goes out the window or needs to be repriced, but a lot of it has to do with fuel.
Yes, I think you're right. I think the good news from even today's inflation numbers in the UK, I was speaking to Ben Nabarro, our economist, this morning, under the hood, actually, it's not as bad as the headlines suggest. You know, we'd hoped it would be nearer the 3% overall level for CPI, and we'd hoped that services component would be below the, you know, well below the 6, really. And I think that is what you probably need to see to start that June cutting. And again, it's a little bit like the US story, you know, and for us, we're going to be really looking very closely at core PCE next week in the US, and I think that number is really critical. Like, we think it probably has to come in at 2.7%. Otherwise, I think our expectation that you could still see those June cuts in the US probably starts to get really challenged, and then you get into a very difficult period for the Fed to cut, particularly with the election cycle then coming up. And like, if you start cutting in, say, September, it's really probably very close to that election window.
I mean, Larry Summers is definitely an outlier, but he's also, you know, saying we can't underestimate the fact that the next move could be higher.
Yeah, I think there is definitely some risks that could be the case because of that stickiness. And I think when you and I spoke a while ago, some of the easing in financial conditions that we'd seen at the back end of last year has perhaps triggered some of this stickiness and some of this re-acceleration in certain areas, or at least the narrative suggests they believe it is. There are definitely cracks forming. And I think even if you look at like part-time jobs versus full-time jobs, that's a sort of set of data that tends to lead payrolls. And I think, again, that is suggesting some of those cracks are likely to come through more substantially to the US. And to our mind, the risk is the longer we see these central banks waiting to cut rates, the bigger the risk to the underlying economy. Probably the more easing then needs to happen if it's later, and the risk that you do really start to see a few recessions kicking in more meaningfully around the world, I think, grows, Francine.
So I guess that's a problem for the end of the year. Is the dollar strength more problematic for certain, you know, asset classes?
Yeah, I think as we're seeing even this morning, like that sort of FX vol is really likely to pick up. You know, you're going to see that risk for emerging markets growing. It's going to be very difficult for them to perform with that dollar strength. And I think, you know, the dollar strength narrative had been something we'd expected to see at the back end of the year, but now we're obviously getting that earlier on. Like, I agree with you. I think there's going to be certain asset classes that are really going to find it difficult to perform well, and certain companies, of course, they're going to see their earnings downgraded on the back of that, which makes the Goldilocks scenario that many people have been expecting, particularly for the S&P, really difficult to achieve now. You know, our Goldilocks scenario is 5,700, but that is predicated on those rate cuts coming through, which, as we discussed, are being priced out by the market, but also better growth coming through from these companies. And I think to get those two things together is looking more and more challenged. Of course, I think if you've got a better growth narrative for the markets, equity markets can cope with rates being priced out. But if those rate hikes being priced out are really because inflation's incredibly sticky and problematic and growth isn't as good as we think or hope, that's a really big challenge to hold even these levels.
But Lucy, so to your very good point, if they actually wait too much and then have to cut quite rapidly, risking, I don't know whether it's bubble, like how do you construct your portfolio now to make sure that you don't get burned out in a couple of quarters?
And I think because there's so much complexity and uncertainty around the world, broad diversification is absolutely key. So we do still like US equities here for a number of reasons, but we would also be fairly thoughtful around, for example, rates. Right? We like US rates, we like European rates, and again, some of that is predicated on the likelihood that the ECB is now going to be the first to cut. You know, again, we've heard those indications that probably most likely they're going to go in June.
Which is not unproblematic for the ECB, by the way.
Yeah,
right?
Indeed. From a rates perspective now, I think that is the consensus, is that they will be obviously starting to cut in June. There's now this big question mark, even from this morning, with the data we saw in the UK and the wage data yesterday in the UK. Maybe the UK can't go as early as June. And I think for the US, again, as discussed, that's been pushed out. So given that dynamic, we do like US and we like European rates relative to the US. And I think that is going to open up a number of other trading opportunities for investors around that theme as well, given the underlying dynamics of growth really quite different now between the UK and Europe versus the US, well below those pre-pandemic levels in the US and Europe relative to the US, where you've got this very strong demand side coming through.
Lucy, thank you so much for joining us. Lucy Baldwin, they're Global Head of Research at Citigroup. But now we're also getting some breaking news on corporate. Toshiba planning to cut 5,000 jobs in Japan. That's according to the Nikkei. Now, coming up, UK inflation is slowing less than expected last month as fuel prices crept higher. We'll discuss the economic outlook with Philip Hammond, the former UK Chancellor of the Exchequer. We'll also talk defense. This is Bloomberg.
Top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
That situation we were in 18 months ago with inflation at 11.1%, that is well and truly behind us. We think we have very strong growth prospects. So the feel-good factor as interest rates start to come down, as people start to feel higher real disposable incomes, will be stronger in people's minds come the early autumn.
Well, that is the UK Chancellor of the Exchequer, Jeremy Hunt, speaking to us in New York yesterday. Let's stay on the UK economy. Inflation slowing less than expected last month as fuel prices crept higher, underscoring the reluctance of central banks to actually begin cutting rates. Well, here to discuss the UK's economic outlook is the former Chancellor of the Exchequer, Philip Hammond. Mr. Hammond, thank you for joining us. I mean, we talk about the economy, but also you're also Defense Secretary, and it almost feels almost more important in this day and age with all of the uncertainty and the defense spending. Would you, first of all, agree with former defense secretaries that we just have to increase defense spending now?
Well, I think we will have to increase defense spending in a measured way over a period of time. And I think a great deal depends on, post the American elections, what the position of the US is around NATO in Europe and how clearly we can rely on the continuing guarantee of the American alliance in the defense of Europe in the future against potential Russian aggression. But there's no doubt we're not spending enough on defense. None of us are spending enough on defense. And we're going to have to factor that into what is already a very difficult public spending agenda for the UK.
So what happens to UK defense and European defense if Donald Trump is, for example, elected and says, actually, NATO needs reforming and we're going to give a lot less to it?
Then the Europeans have to step up and fill the gap. And that's quite a big gap to fill because we're heavily dependent on the Americans for many strategic elements of our defense. I don't just mean the nuclear deterrent, but the ability to airlift large numbers of troops, for example, depends crucially on American support. So we would need to invest quite a lot more money in defense. I think the important thing here is that the overall envelope of public spending cannot continue to expand. So when we talk about these things that we have to do, decarbonisation, increasing our defence spending, we also have to talk about what we are going to do less of in order to be able to afford these things. That's the grown-up debate. And to be very honest with you, it's quite difficult to get that debate going in an election year.
So how would you do it? You're always look at the numbers and always try to balance out. First of all, defense, does it need to go to 3% of GDP, or is 500 million one-off enough? Not yet
3% of GDP, and money isn't the only issue. We've also got to be able to recruit enough people. At the moment, the defence establishment is struggling to recruit the people it needs to spend its current budgets, to use its current budget allocations. So the two things go hand in hand. But I think, look, go back to what the Chancellor was just saying about growth. In the end, this is all about growth. If we have strong, consistent economic growth driven by productivity increases, not just by a growing population, then we will be able to afford to do more, including, over time, more public spending. But first of all, we have to get that growth equation right. And although it looks like we are now getting on top of the inflation problem, which has been the predominant theme for the last couple of years, we still have this long-term challenge in the UK that our productivity growth has been very flat ever since the global financial crisis. And our economic growth is simply not strong enough to support an aging population with a very sharply rising demand for public services.
But so how do you actually fix the productivity problem? The U.S. productivity numbers are a little bit better because of a large number of immigrants actually coming to the country. Does AI help with productivity? How would you go around it?
Technology can indeed help with productivity, but we've got to make sure that we adopt and innovate in the right way, that we seize the opportunities that are available. I agree with the Chancellor. I think the UK growth prospects are significant. We've got a very good track record of technology adoption. British people are very open to using technological innovations in their everyday lives, more so than in many other countries. So the raw material is there, but we've got to make sure we seize the opportunity. And one of the challenges of democracy, of course, is that we have to persuade people that they want things to change. And people are very conservative, with a small c, often don't like change. And it's about selling change to people, working out how, in a democracy, we have those big debates and we reach the right long-term decisions around these big, difficult issues. Because many of our adversaries, and even many of our friends around the world who are competitors with us, don't operate the same kind of democratic system, don't have to build the same kind of consensus that we do in the liberal democracies of Europe.
So one of the more immediate, and these are longer-term, extremely difficult subjects, very important. On the short term, I mean, does it make more sense to increase defense spending or cut taxes? And that could also lay the foundation, actually, for future growth either way.
Well, look, I'm strongly in favour of an agenda to cut taxes over time as we can afford to do so. But we can only cut taxes if our public spending is less than our tax receipts. Driving economic growth, achieving higher levels of economic growth should increase tax receipts and should ultimately enable us to have both lower taxes and higher spending on public services, including things like defence. But we've got to do things in the right order. First, you grow your economy, and that requires investment, maybe at the expense of consumption. But the consistent theme, if you look across countries around the world that have achieved decent levels of economic growth over long periods of time, the consistent theme is high levels of saving and high levels of investment. And we've got to do better in that area. Once we've done that, and we're running surpluses in our public finances, then we can start looking at cutting taxes. I'm afraid, as Liz Truss and Kwasi Kwarteng demonstrated a couple of years ago, trying to do it the other way around, cutting taxes first, funding it by borrowing, simply doesn't work.
Philip Hammond, thank you so much. We'll come back to the former UK Chancellor of the Exchequer. We'll talk a little bit about investment and actually what investors tell him when he travels the world. We'll talk also geopolitical tensions. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back. Still with us, Philip Hammond, former UK Chancellor of the Exchequer and former Defence Secretary. Thank you so much, Mr. Hammond, for staying with us. We were having a good conversation about really the blueprint that you saw for the UK economy. When you look at UK defence and foreign policy, should the UK continue to sell arms to Israel if they are in breach of international law?
Well, we have a very clear and strict regime about who we can and can't sell arms to, and these things are reviewed very intensively when there's a period of conflict or disturbance going on in the world. So, it's not for me to second-guess that judgment that will be made internally within government according to the rules. But we have one of the strictest arms export regimes in the world, and I'm confident that it'll be operated properly. Often people on the outside say, well, it's obvious you shouldn't be selling arms to this country or that country. Things are often a little bit more complex than that in terms of the way international law works and the way the rules are applied.
When you look at, we're on tenterhooks, and this was quite difficult 4 days in the Middle East trying to understand how Israel retaliates if they retaliate. Do you think the Prime Minister will?
Which Prime Minister?
Netanyahu.
The Prime Minister of Israel. Look, I think it's very difficult for Israel not to retaliate in some form to this Iranian action. Prime Minister Netanyahu will be getting urged from all sides, including the UK, to ensure that any response is moderate and non-escalationary. I honestly don't believe the regime in Tehran wants to provoke an all-out war with the United States and Israel. That is not in their interest, but they also have their domestic audience that they have to satisfy. Prime Minister Netanyahu is in the same space. He has a very difficult domestic balancing act, and that's one of the big drivers in the evolving geopolitical situation in the Middle East. The trick, which the Americans in particular will be working on at the moment, is finding an action that the Israelis can take which satisfies Israel's amour propre without provoking Iran into a further counter-response. I don't know what that is, but I hope very much that they manage to find something that works.
Okay, speaking about your Prime Minister, the UK Prime Minister, Rishi Sunak, is there a chance, actually, that the Tories do something that will not be a complete wipeout at the next general election?
Well, look, there's always a chance because the world is an unstable and unpredictable place. And lots of things could happen between now and the autumn when the election will probably be held. I think it's what the Chancellor has said to you is probably right, that the feel-good factor will be starting to creep back into the economy. So the economic situation after a very difficult few years post-COVID will start to look and feel a bit better. But we've got a long way to go, let's be honest. The polls are suggesting that the Conservative Party has a mountain to climb at the next election. But never say never, because events can change people's minds very quickly.
But is it possible for the Conservative Party to win it on the economy?
I think it's a challenge, to be honest, because I think, although I think the economy will be improving by the autumn, I think that many people have in their minds the events of the autumn of 2022, the mini-budget, the spike in interest rates and so on. And, you know, the Tory party's principal pitch to the public has always been our responsible management of the economy. I trust Jeremy Hunt and Rishi Sunak completely on responsible management of the economy, but I think what has happened in the recent past has damaged that brand, to be honest, and we've got to rebuild it.
Does it matter if the election is too close to the U.S. election? Would that worry you?
No, I suspect our election will be close to the U.S. election. I think the question is whether it's just before or just after.
Does it make a difference?
I really am not sure. I'm not sure whether it makes a huge difference.
Philip Hammond, thank you so much for joining us today. That was the former UK Chancellor of the Exchequer. Coming up, we talked to Poste Italiane Chief Executive Matteo Del Fante as the Italian government prepares to sell almost a third of its stake. So we'll talk about some of the challenges, of course, of privatization and then going back to the markets. So we also look at dollar, one of the biggest, as far as I remember, one of the biggest weeks we've had since, of course, all expectations on the Fed changed last Wednesday because of the inflation print. So we look at treasuries, markets, and of course we look at dollar strength. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Jay Powell signals the Fed will wait longer than previously anticipated to cut rates following a series of surprisingly high inflation readings. The latest CPI numbers in the UK are also stronger than expected, prompting traders to further unwind bets on how many rate cuts the BOE will deliver this year. Plus, chip machine giant ASML misses estimates on first quarter bookings, but it signals a stronger second half and sticks to its guidance. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So the Italian government is preparing to sell almost a third of its stake in postal operator Poste Italiane, worth 4.4 billion euros. Now, the sale is crucial to Prime Minister Giorgia Meloni's plan to offload 20 billion euros worth of state-held assets by 2026. Now, let's get more from Poste Italiane Chief Executive Matteo Del Fante. Mr. Del Fante, thank you so much for joining us. I mean, it's busy times, exciting times. So we heard from the Italian government that they plan actually to sell a stake in Poste. Do you know how much, and do you know by when?
So I hear, or I read. Yeah, no, we're waiting for instructions and indication from the shareholder. So, we're just managing the company. We presented our 5-year plan on the 20th of March, and we carry on business as usual, waiting for directions.
I'm sure you meet a number of investors. Do they understand what you have been building? Do you think there's there'll be a fair valuation, so people are interested, they understand, the opportunities and the challenges?
I think now is 7 years that, we launched the original Deliver 22 plan. Investors starting to understand the idea and the strategy of building a multi-product platform. So we are showing them that we're delivering in every single vertical, in every single product vertical, but we're getting the benefit of the platform effect. So I think I find investors much more informed, much more interested into the story, and that's really creating good momentum for us.
So have you also potentially tested investor appetite for a deal?
They do it. It's kind of a reverse. It's kind of reverse. I mean, they mentioned that if and when they would be interested, but again, we have to wait for the right time, as the general manager of the Ministry of Finance stated yesterday publicly.
So talk to me a little bit. I mean, there's, for example, you have also a telecoms component. So for foreign investors, right, they think of Poste Italiane, they think of Royal Mail. It's not the same institution because you're trying to build, as you say, like a multi-platform.
No, I think we're very different from most of the incumbent and historical postal operator, because we diversified starting from, end of last century. So the real market diversification started late 90s into financial products, and that's postal savings, which are government guaranteed, is life insurance saving products. Then diversified into payments and became the largest issuing payment institution in the country, and home services. The post office is everywhere in Italy. It's a natural place where to go and buy a home service such as broadband or electricity or gas, retail. Always on the retail side.
So when you look at your various businesses or actually angles, what do you think will perform better than others in this kind of, again, inflationary environment? Maybe the ECB cuts, but it's all a little bit uncertain.
Well, that's we managed to stabilize our investment portfolio. We take no credit risk by law, so we invest into government securities. So we're mainly fixed rate, so we're much less sensitive to interest rate fluctuations. And in the plan, the area that will grow the most over the next 5 years is the everyday household needs. So is the payments, is the TLC, is the energy and gas in terms of volumes. In terms of bottom line contribution, the lion's share is still with our insurance and postal savings, which is the core.
Is there any appetite in, for example, increasing your exposure to telecoms, Telecom Italia, maybe looking for a partner after the sale of the grid?
No, I think it's, we have, a small 5% market share, and this is enough. I think the government has designed a specific road for that company, and that's fine by us, obviously.
So is there any changing? Like, what are your day-to-day challenges?
I think it's, that's a good question. I think it's really execution. The plan is there. It has been an acceleration of the final end of the last plan, and now we have to basically execute on it mainly on two lines. One, getting closer to clients with our commercial service model in financial products. So we need to be and become a bit more dynamic, not transactional, but more relational. Oriented in the post office, and then there is the big transition of the operation of mail. Italy, unfortunately, is very, very low volumes in mail, and that is pushing us to do something before UK, Germany, France, or the US will have to do it.
Why? Why is it so low?
Historical reasons. 7 years ago, there was a very good invoicing and procurement electronic law. So in Italy there are no more paper invoices since 7 years. Italians are not using for personal reasons or private reasons mail as much as I see around Europe. Bottom line, we have 35 items per year per head with a European average of 130, which is bad news in terms of volumes and business, and we have to turn it into a good news, an opportunity to put our network to do something else, and obviously that's parcel.
You also parcel, which are increasing. I imagine. Do you see the volumes after COVID?
Yeah, there has been a kind of,
right?
There has been leveling off just after COVID, but then, the market started growing, high single digit from, 2022 onwards, really.
Matteo, I was also excited to have you on because we talk about economies and we talk about, consumer spending, the abstract, but you live this every day because you have customers that you interact with, that you see, and you see the numbers. What is the health, actually, of the Italian consumer right now?
What we see from our data, we also run, some small models of nowcasting, trying to understand, how things are really developing short term. And the signals we have is that, consumption is holding relatively well. We don't see the investment side. It's true that the consumption of our mass clients, because we're really on the mass, the man of the street, we're not on the, high net worth client base, is mainly anchored around primary goods. Okay, so you have less volatility around those, but from our point of view, is demand is holding.
The ECB may be the first one to cut, which is quite incredible. If you told me this 2 months ago, no one would have believed it. Yeah. Would it be welcome, actually, for your customers, an interest rate cut?
I think, from our client standpoint, is not a major, it's more on the, industrial and production side, the banking sector, there are players, our client base doesn't really have, maybe the mortgage side. Mortgage started since 9 months to go down, so that's what retail probably will be more sensitive to.
Matteo, going back to the share sale, and I know you can't, you say you're expecting a call to say when and where. I don't know if I 100% believe that, but when the markets are quite volatile at the moment, right? Because of the Middle East, there's a lot of unknowns. Like, do you worry about just the market volatility unrelated to Poste Italiane?
Yeah, obviously, from what we see, there is still relatively good liquidity. Markets are open for primary and secondary offerings, from what we hear from brokers. Timing is everything in markets, but, we're here for the long run. So, we're not, worried.
Okay, thank you so much for joining us. That was Poste Italiane Chief Executive Officer Matteo Del Fante with us in London today. Now, coming up, we talk luxury. LVMH shares up after first quarter update was a little bit better than actually most people feared. So more next on why the luxury sector sentiment has soured generally. This is Bloomberg.
The younger generations are more, of course, pay more attention to
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
That is well and truly behind us. And if you're looking forward in terms of longer-term growth prospects, the IMF today are saying that the UK will grow faster than France, Germany, or Italy over the next 6 years. So we think we have very strong growth prospects.
So you aren't concerned at all about what potentially could happen to parts of the UK economy, like the labor market, if policy were to stay too tight for too much longer, given what you are saying is a downward trajectory in inflation?
Well, obviously, in the short term, we look to the Bank of England to get that fine judgment right. But what finance ministers like me can do is much more about the longer-term competitiveness of the UK economy. And we note that the IMF today say there's a whole section about the impact of AI on the UK economy because they recognize that London is now the world's second largest epicenter for AI R&D after San Francisco. And there's a huge amount happening in our tech economy, which is third only to the US and China globally. And that is really where the big growth in the future is going to come in the UK, and that's where we think makes it a very exciting bet for investors.
Well, and your point is taken, Chancellor, that you oversee the fiscal side, not the monetary side. So on the fiscal side, you have suggested that an election could happen potentially as soon as October. Should we expect another potential fiscal event between now and then, or have we seen all we're going to see on that front before the votes are cast?
Well, it's certainly the case that, the feel-good factor as interest rates start to come down, as people start to feel higher real disposable incomes, will be stronger in people's minds come the early autumn than it is now. People have been through a very bruising period. Obviously, decisions about election timing are for the Prime Minister, and were we to have an October election, as I've said before, it would be possible to have a fiscal event in September, but we would decide much nearer the time whether that was the right thing to do.
Well, of course, you've already delivered a lot fiscally in terms of tax cuts, including personal tax cuts, and yet when you look at polls, obviously the Conservative Party is still running significantly behind Labour, I believe by roughly 20 points. What else may need to be done on that front to convince UK voters to keep the Conservatives in power? What would you consider doing?
Well, I'd be very cautious about looking at those polls because, first of all, as we can see from the challenges facing incumbent governments, not just in the UK, but in the US and Germany, France, the electorate have been through a really difficult period with an energy shock, with high inflation, with a pandemic. But when it comes to a general election, it's a choice about the future. It's not a referendum on how you feel right now. And that becomes a very different decision in people's minds.
That was the UK Chancellor of the Exchequer, Jeremy Hunt, speaking to us in New York. Now, for some of the other stories making news today, well, Bloomberg has learned that Morgan Stanley plans to cut about 50 investment banking jobs in the Asia-Pacific region starting this week. At least 80% of the reductions are likely to be in Hong Kong and China. Now, Emirates is halting all check-ins for passengers for the day as bad weather in Dubai disrupts travel in one of the busiest aviation hubs in the world. Well, Dubai has seen torrential rains and heavy flooding, prompting flight cancellations, school closures, and traffic disruptions. Now, it stemmed partly from cloud seeding operations that are meant to encourage rainfall in the UAE. And LVMH shares are higher after its first quarter update was better than feared. Now, the world's biggest luxury group has been hit by weak demand for cognac and champagne, posting its worst quarter results since 2020. Now, for more on all of this, we're joined by Andrea Felsted from Bloomberg Opinion. Always great to speak to you, Andrea, because you understand, really this industry like no one else almost. When you look at, it's better than feared. I mean, there was a real fear that LVMH, that for so long was frankly killing it, like doing so much better than Kering and some of their other rivals, would get hit quite hard this quarter.
Well, they have been hit quite hard. I mean, there's really very little growth. All the growth came from pricing. It's 2% for fashion and leather goods, excluding the pandemic period when stores were shut and everything was shut down. This is the weakest since 2016. And at that time, we were in the midst of that anti-sort of ostentation cut down in China. So this, yes, it has been hit. We mustn't forget this is a big slowdown.
So when you look at LVMH, I mean, they have everything, right? They have the makeup, they have the clothes, they have the bags, they have Louis Vuitton, which makes a sizable chunk of everything. They also have the drinks. Where did we see the most weakness?
The weakness was actually in the drinks, and it's the same factors that's hitting luxury. Some of those sort of aspirational US consumers have cut back on, pricey drinks as well as pricey handbags, as well as weak demand in China. So that was worse than was expected.
And so where do we see the most strength? And if LVMH is it doesn't have a great set of numbers, even if it's better than expected, what does it mean for the rest of the industry?
Well, a great strength within Sephora. They haven't seen the same downturn in US demand for beauty that Ulta said, so that's a positive. I think LVMH will turn out to be one of the better performers, just as we shouldn't have taken the profit warning from Kering last month as a sign for the rest of the industry. We shouldn't really take this as a sign for the rest of the industry. LVMH, it's massive. No. It's got the resources to invest, to shout louder than anyone else, so their brands are at the forefront of consumers' minds. Hermes will probably do well, Brunello Cucinelli. Kering, we know, will be weak. I'd keep an eye on Burberry. That's in a bit of a tricky spot, trying to elevate its product, do a new creative direction at a time when things are difficult. Richemont, probably good on jewellery. LVMH's watches are tough, so that's one to watch too.
So is the trend, Andrea, still going for ultra high net worth?
Yes.
So price increases, the is it still about quiet luxury?
There are increasing signs that quiet luxury has peaked. I mean, we're just looking at some of the TikTok aesthetics that are coming through, this kind of louder luxury, the mob wife, the big fur coat, the loud makeup. That was a sign that quiet luxury had peaked. The very Western trend we see at the moment, not exactly quiet. So I think we could see a change in that over the next few months.
I mean, the maximalism definitely speaks to my Italian heritage. I know you're much more chic.
No.
Why is Hermes keep on doing well? Is it smaller volumes and just more handcrafted?
Hermes is in a really different position because it's got wait lists for its iconic bags, so it can effectively dictate its own demand. It's also carrying on raising prices. It perhaps didn't raise prices quite as much as, say, Chanel when everyone else was increasing. So it's got a little bit more scope to raise prices. And there's a halo effect. You know, we might not all be able to afford a Birkin, but we can afford a Hermes scarf or some Hermes makeup. So it's got those three factors going in its favour.
Actually, it is incredible the number of luxury companies going more into makeup, right? We could expect, like, I don't know if Prada's looking at this or whether it has, but is this going to be a viable source of revenue for them?
Yes. What has happened is with the price increases over the last few years and that everybody wants to cater to the 1%, they've effectively priced out a huge cohort of the market. They need to find ways to reconnect with that segment without damaging their brands, and beauty is one way to do that.
Wonderful. Andrea, thank you so much for all of the insight. Andrea Felstead there from Bloomberg Opinion, looking at luxury and luxury stocks. Now, coming up, ASML reports worse than expected bookings for the first quarter, so more on the Dutch chip machine makers' results next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
India's elections kick off with a focus on the economy, social divisions, and climate change actions that will influence the global story. Bloomberg is live on location with the latest updates from the world's largest democracy. Coverage begins April 19th.
Well, ASML down this morning after new orders fell short of estimates for the first quarter. Europe's largest technology firm has been hit by a slowdown in demand from the chip-making industry. Well, we're now joined by Bloomberg's Sarah Jacob in Amsterdam. Sarah, thank you for joining us. So ASML's new orders in the first quarter actually fell short of expectations. Why?
Yes, good morning. So ASML reported $3.6 billion in new orders for the first quarter, and that is because the companies have been hurt by the downturn in demand for its most advanced machines from chip makers. So to put it in context, the fourth quarter bookings were a record 9.2 billion euros. And ASML's CFO today said that, this sort of illustrates how the order intake process is typically quite lumpy. This quarter is really also a story about how orders for ASML's extreme ultraviolet machines fell to 656 million euros in the first quarter from 5.6 billion euros in the fourth quarter, again, due to the downturn in the chip industry.
So how does China really factor into this, and what is ASML's outlook for the year, Sarah?
So China has become the biggest market for ASML due to a drop in the share of the other markets, and business from that market has remained relatively resilient. From the outlook point of view, ASML has forecast net sales for the second quarter to be weaker than was anticipated, but it has kept its outlook for the full year unchanged. It expects 2024 total net sales to be similar to 2023. The company expects the second half of the year actually to be stronger than the first half. The CFO also said today that it's pretty clear that the industry is in its upturn, and the company is sort of building up for a stronger year in 2025.
Sarah, thank you so much. Sarah Jacob in Amsterdam. They're the very latest on ASML. And let's also quickly look at some of the biggest moves that we've seen in the last couple of days and what this means today. Now, Treasury yields, currently you can see the U.S. 10-year, actually the U.S. 10-year at 4.6366, trading in a narrow range, but still near 2024 highs. Gauge of the dollar actually holding near a 5-month high after Jay Powell said yesterday that it would likely take longer to have confidence that inflation is headed towards the central bank's target. Up next, Bloomberg Brief.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price-wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Good morning from our world headquarters in New York. I'm Danny Berger. Managed Cranny is off today. Welcome to Bloomberg Brief. Let's set your agenda. Another spike in U.S. yields as a hawkish Powell sends the front end to 5%.
So we've said at the FOMC that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. You know, we took that cautious approach and sought that greater confidence so as not to overreact to the string of low inflation readings that we had in the second half of last year.
Chip machine giant ASML plunges after first quarter orders disappoint. And earnings season ramps up as Wall Street battles rate jitters and geopolitical risk. What is stability? Finally calm this morning after 3 days of selling in both this bond market and this equity market. We are backing off of a 5-month high this morning, but don't be fooled. We're up 44 basis points so far this month. Fed futures are now pricing 40 basis points of cuts. That is the lowest of the cycle, but yields down by 2.5 basis points this morning, still at 4.6%. It is a narrative shift with Powell and Jefferson yesterday talking about higher for longer, not yet the confidence to cut. Sterling gains this morning up 1/3%. Cable trades at 124. We had inflation coming from the UK today, coming in at 3.2%. Estimate was for 3.1%, higher than expected, means stronger sterling. Though Bailey yesterday talking about the confidence to cut before the Fed. Finally, S&P 500 futures also taking a break from 3 days of selling, up 0.2%. But as a whole, we are no means de-risking wholesale, but it has been a tough run over the past month so far. Okay, let's get to some breaking news that are just crossing the terminal. Biden is calling for higher tariffs on China steel and aluminum. He is urging higher levies when it comes to a review of Section 301 tariffs. U.S. trade representatives are now launching a probe of China's shipbuilding industry. All of this is part of the steps to woo workers in this year's election. He is visiting Pittsburgh on Wednesday, and he's going to be proposing these new 25% tariffs on certain Chinese steel and aluminum products as an ongoing review. There's aluminum priced LME not moving too much, down 0.2%, little change from where it was before these breaking headlines. Let's bring in Bloomberg's Rebecca Chung-Wilkins on this breaking news. Rebecca, you're in Hong Kong. From a Beijing perspective, how concerning are these new tariffs from Biden?
Well, this excellent reporting from my colleague Danny suggests that actually it's a relatively small segment of the US market that is going to be affected by this. So the equivalent of about $1.7 billion last year. And that's in line with this notion of the small yard, high fence approach that the Biden administration has taken so far. But the absolute numbers aside, I think this development is emblematic of the broader concern that Beijing has here, which is that as we get closer to the election, increasingly areas of Chinese trade in China are going to be deeply politicized, and it does not look like that momentum is kind of pulled back in any way, and that more and more areas of trade will find itself, of Chinese trade specifically, imports into the US, will find itself the target of these types of curbs and tariffs. And I would also say from Beijing's perspective, it underscores the importance when it comes to building these other sort of relatively better ties with European nations. So we have Schulz coming closing his visit to Beijing, where Beijing has been very forthright in engaging and pushing back against those accusations of overcapacity. We also have Xi Jinping going to France, where we can expect him to take a very similar message there. So all of these developments that we see in the US really underscore the importance for Beijing in now managing this relationship with the EU and with European nations, in the hope that this sort of momentum to target tariffs in the US doesn't spill over to other US allies.
And Rebecca, it's no coincidence that Biden is going to make this trip when he's in Pittsburgh. He's going there for a campaign stop today. It's also where U.S. Steel happens to be headquartered too. And he's trying to charm a lot of this union, a lot of the steelmakers, is he not?
Yes, absolutely. That's a sort of, I think, important broader context. We're expecting him to address about 200 members of this union, United Steelworks. Now, that's symbolic importance here too, because this is the union that has opposed the acquisition by the Japanese firm Nippon Steel of U.S. Steel. And so these tariffs, although relatively small, relatively targeted, fit into this broader agenda with Biden when it comes to trying to woo this really critical cohort of his electorate.
Rebecca, thank you so much for breaking down that breaking news for us. That is Bloomberg's Rebecca Chung-Wilkins. Again, just to reiterate, the Biden administration is going to be calling for higher tariffs on Chinese steel and aluminum during a campaign stop in Pittsburgh today. To the macro story, it's a series of high inflation readings, and after which Chair Powell spoke yesterday. And bad news, he signaled that rate cuts might come later than expected.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. The performance of the U.S. economy over the past year has really been quite strong. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Let's bring in Bloomberg's Sam Unstead on this. Sam, immediately after Powell, we saw a front end that went up to 5%. It's backed off of that this morning. But this was the one thing that the bond bulls could hang their hat on, that we have a Powell put, that surely Powell will continue his dovish tilt in his propensity to cuts. Is that now out the window?
It's certainly, I think he's certainly pushed back a little bit harder than he has previously. I think, what he'd said actually had been front run by the market quite a bit, starting with the inflation data last week, then the retail sales data, had a whole host of Fed speakers as well over the course of the last week or so, pushing back a little bit further on those rate cut bets. What Powell said really has just underpinned a lot of that, and that narrative that we've had, as I say, that started with the inflation report last week, that fed particularly into treasuries, has kind of already front-run what Chair Powell said yesterday.
And Jefferson saying something similar yesterday too, saying persistent price pressures means higher for longer. And Sam, this all starts to get a bit awkward for the other G10 central banks, specifically the ECB and the UK. Lagarde has made it clear that they are ready to cut, even if the Fed is not. Bailey yesterday saying something similar too. And now you have a Powell who's essentially solidifying this idea that they don't need to cut right away. I mean, this is getting tricky.
Yeah, it is, and actually what you said there, Danny, is right. That that's something that's been coming up quite a lot more over the course of the last week, is whether the Fed needs to cut at all. As those rates have been pared back, the economy remains very strong. Inflation, they've had now 3 in a row, which have been relatively sticky. That narrative has now been baked in. For the other central banks, they are, that's the other story that's kind of, the other narrative that's going alongside the Fed is divergence from the Fed. And the question of whether they can cut before, I think they can. The ECB or the Bank of England, certainly the inflation dynamics in each country would point to both of those banks cutting before the Fed. But, and I'd point actually to some really good stuff on the Markets Live blog here at Bloomberg in the last week or two, that actually it's very rare for them to front run the Fed. And when they do it very, very cautiously. And so the central banks here, ECB and BOE in particular, may well cut first, but they probably still will remain very, very cautious in going any further than that until the Fed really starts to look at cuts.
Of course, Sam, adding to the awkwardness is the fact we got UK inflation data hotter than expected, 3.2%, 3.1%. I mean, bad time for Bailey literally just yesterday saying that they're kind of ready, or at least on the path to being able to cut. I mean, Bailey has made the mistake before, has he not, Sam, where he says, oh, we've turned a corner, things are getting better, and then the data says otherwise.
I would say the data does say otherwise, but it doesn't say it really, really loudly. Like the inflation data is certainly moving in the right direction. The really key concern is the services inflation data, which the BOE has been looking at very closely. The wage growth figure we also got on Tuesday. Those two things will add to a more cautious BOE probably going forward. But actually, in terms of their forecasts, everything is not too far off. So yes, it's June may be starting to no longer be in the picture for the first cut, but the second half of the year, and a lot of what's come through my inbox today from people reacting to the inflation data, is that the second half of the year does remain on, and inflation is going to keep going down. It's almost certainly going to hit the 2% target next month or the month after that, and then remain around that kind of level. And so, although it on the surface of it, it looks bad, I think you can see from the market reaction today, even though you've had a pullback in bets on Bank of England cuts, that a lot of this has already been baked in through the Fed and through that kind of broader move.
Sam, fair enough. Bloomberg Sam Unstead, thanks for joining us this morning. Okay, let's get to some of the other top stories that are trending on the terminal this morning. Saudi Arabia and the United Arab Emirates are calling for maximum self-restraint as tensions between Israel and Iran boil. It's an unusually frank joint statement from the two Gulf countries. The comments come after a call between the Saudi Crown Prince and the UAE's president, warning of dire consequences of a wider war. ASML shares down after new orders missed in the first quarter. It's expecting weaker than expected sales in the second quarter before demand starts to pick up. ASML is the world's sole producer of equipment needed to make the world's most advanced chips. The U.S. Securities and Exchange Commission has blocked third-party messaging apps like WhatsApp on work phones of its own staff. The regulator has been cracking down on Wall Street over WhatsApp use. Another regulatory agency, the CFTC, is also considering a similar move for its employees. Coming up, shares of LVMH bounce back after other luxury stocks post first quarter better than feared results. So what's the breakdown? Cognac is out. Leather goods at Louis Vuitton are in. We're going to have more on that next here on Bloomberg Brief.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg Brief. I'm Danny Berger. Shares of LVMH are regaining its post-earnings losses amid hopes for a pickup on growth. For more, let's bring in Sweta Ramachandran of Artemis Investment Management, who joins us now. Sweta, this is a case of if I had known the numbers before, I wouldn't have expected this to be the price action of shares higher by 3.8% this morning. You had sales growth that slowed on handbags and wine and spirits, the slowest pace since 2016 if you exclude the bump during 2020 lockdowns. So is this more of a normalization than a squeeze? How do you account for the market reaction?
Yeah, I think the overwhelming sentiment really is one of relief, because this had been widely flagged to be the quarter with the toughest comparisons for LVMH on a quarterly growth basis. That normalization that you refer to, that's certainly, after the boom in 2021 and 2022, we'd started to see that normalization come through in 2023. It was expected to accelerate in 2024, which is certainly what's happening. But that path towards normalization is bumpier for some companies than it is for others. And LVMH really has shown us what it's like to have, at least on the surface, I'm sure internally it's been quite difficult to achieve, but externally it appears as if it's achieved a smoother and softer landing than many other companies in the sector are seeing.
I mean, can you go over the cognac results? We were talking about this a bit in the break, because this is also a surprise to me, because I would have figured cognac does poorly and it's a change in consumer taste, but it's not really that, is it?
Right. So the wines and spirits number on the face of it was quite a shocker at -12%, but that was explained as being primarily related to shipments because of the structure of distribution, where it's not a retail business, that they have to make sales to wholesalers who then sell to the end consumer. And what's happening at the wholesaler level is an element of destocking, which has been persisting for about 6 to 9 months, and which accelerated actually in the first quarter of the year against the company's expectations. What they did note was that end consumption, which is measured by a sell out to consumers, was actually flat in US cognac for the first time in 18 months, and that wholesaler inventories are actually running very low. So if we do start to see a more material pickup in end consumption, that should come through also in shipments to wholesalers.
Okay, so for Chinese demand, let's talk about this, because at home and abroad, Chinese demand, as we've been talking about, Sweta, for LVMH was good, rose 10%. And I have to say that feels somewhat shocking, because the narrative has been one of wealthier Chinese not shopping as much because of unemployment looking particularly bad in China, housing slowdown, having that wealth effect, and a downturn. So what does that narrative get wrong, which means LVMH can have that boost from the Chinese consumer?
Yeah, so I think that's really very much about top down versus bottom up, where it is true. I mean, Kering produced a shock revenue warning last month for the first quarter of the year, where they suggested that sales for Gucci, particularly in Asia Pacific, would be very weak, which again cast a pall on the entire sector. However, what's happening with Gucci is a very specific brand repositioning due to the designer change, which isn't necessarily indicative of what's happening everywhere. So it's clear that polarization in China with the Chinese consumer is accelerating, and that certain brands are outperforming others, including LV brands. The other element, I think, is that we've forgotten, because China has been in lockdown for so long, but that prior to the pandemic, about 70% of what Chinese consumers were spending on luxury goods used to take place outside of China, which was, of course, all repatriated back home during the lockdown years. And that now the Chinese tourists are starting to travel the world again. They're starting to look for deals in other parts of the world, which also explains why LVMH's sales in Japan were up so significantly in the mid 30% range in the first quarter of the year, as more Chinese start to spend abroad than at home.
So this idea, though, of Gucci and Kering not doing as well in China, this gets to this idea that you write about, that we are no longer in a rising tide lifting all boats luxury market anymore. It has been lumpy. Kering doesn't do well. Burberry doesn't do well. What's changed? Why is this the environment where when luxury shoppers are out, they're not shopping across the board?
So I think in 2021, 2022, what we had was this sort of pretty indiscriminate boom fueled by stimulus checks, fueled by revenge purchasing. And that has now normalized. We're going back to the historical clip, which is the industry growing at about 6 to 8% per year, within which we have winners and we have losers. I think that's an environment that has definitely changed. And within that, brands that are resonating with consumers tend to win an outsized share of market growth at a time when the market itself is is slowing down. Consumers tend to concentrate their purchases on top-tier iconic brands rather than perhaps more experimental purchases, which again goes to reward brands that have consistently invested in brand equity. If we look at the marketing budget of LVMH, their fashion and leather goods segment spends as much on marketing as the entire annualized top line of Tod's, Ferragamo, and Burberry put together. So it's hard, it is hard for the other players in that context to even stand a chance against this marketing firepower.
Yeah, I mean, at least they're not leaning into the mob wife chic. I think that's gone already anyway. We'll talk about trends some other time, Sweta. I think that's all we have time for. Sweta Ramachandran, thank you so much, of Artemis Investment Management. Okay, coming up, yet again, Boeing under scrutiny, this time their safety record in 2 separate hearings on Capitol Hill. We'll have that for you next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide crate index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Two separate Senate hearings will bring Boeing's safety issues under a microscope after a whistleblower's claim of poor assembly process. So that kicks off today. Let's bring in Bloomberg's Sid Phillips, who joins us for more. Sid, I mean, how many times are we going to have to do this? It's remarkable to look at the latest whistleblower's allegations, or at least what he proposes to say in front of the Senate, that there were well-telegraphed shortcomings in the company's safety culture. And so it's not a surprise. What else are we likely to hear in these hearings?
Morning, Danny. So yeah, these two competing hearings are going to sort of put Boeing under the microscope yet again. Sam Salapo, the whistleblower, says that the 787 is not safe, and he alleges that Boeing took shortcuts in the manufacturing of the 787. That's separate from the 737 MAX, which has been under lots of scrutiny. The 787 is Boeing's wide-body long-haul jet, and it's sort of key to Boeing's cash flow. And essentially, he's alleging that Boeing took shortcuts in the manufacturing of the process, and that's really structurally unsafe for the aircraft. And Boeing has refuted those charges. They've said that they've done lots of studies and investigations, and they found nothing of substance in those allegations. So that's going to be an explosive testimony this morning. And separately, there's also an FAA report on the safety culture at Boeing that was pretty damning when they sort of released it. And the Senate Commerce Committee that's led by Senator Maria Cantwell is basically listening to testimony from experts on the safety culture at Boeing. So two major hearings for Boeing on Capitol Hill this morning, and both of them aren't really going to be good news for the company.
And you know, obviously from just a PR perspective, it's disastrous yet again to have this thrust into the spotlight. But what potential outcomes, whether it be FAA or broader government action, could come from a result of these various testimonies?
So it's still to be determined what the whistleblower alleges in terms of being able to back up his claims. But the FAA said it is investigating the claims that he's made, and that will be sort of key to see what the next steps for Boeing and what the regulators will sort of come down on the 787 or what changes that they might recommend. But at the same time, I mean, Boeing's been under immense scrutiny from both regulators, airline customers, and the general public, and this is not going to really help their case in terms of being able to say, everything's behind us, we're sort of moving on from here. This is going to add the spotlight again on Boeing's on their cultural issues and their safety issues and how they make their airplanes.
Sid, has Boeing said anything yet about these various panels or in reaction to what we've heard of what the whistleblowers are likely to say? And only about a minute here.
Yeah, Boeing has really said that they've disputed the allegations that the whistleblowers made. They've said that they've done extensive tests, they've done extensive scrutiny, and they haven't found any merit in those allegations. At the same time, I mean, Boeing is in the midst of a massive change. Their chairman stepped down, they replaced the head of their commercial aeroplane division, and the CEO, Dave Calhoun, is due to stand down at the end of the year. So they are in the midst of all of these changes, and it's going to be just add more pressure to the company that they need to ramp up the pace of that.
Sid, never a dull moment in your world. I think we're all looking forward to the day where it's only dull moments for the airline industry. Sid Phillips, thank you so much. Coming up on the program, we're going to dive into the technical analysis of the sell-off in earnings season. Jay Woods of Freedom Capital Markets is joining us on the economic data and the earnings ahead as U.S. stocks rebound after 3 days of selling. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg. Welcome back to Bloomberg Brief. I'm Danny Berger. Here's what you need to know. Another spike in U.S. yields as a hawkish Jefferson and Powell send the front end to 5%.
So we've said at the FOMC that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. You know, we took that cautious approach and sought that greater confidence so as not to overreact to the string of low inflation readings that we had in the second half of last year.
Chip machine giant ASML plunges after first quarter orders disappoint, and earnings season ramps up. The Wall Street tightens battle rate jitters and geopolitical risks. Stability and calm finally this morning after 3 days of selling, after yesterday the front end touching 5%. We heard from Powell, but maybe it was geopolitics in Jefferson saying that persistent price pressures mean higher for longer, which really fueled the losses in the bond market. We gained today, yields down by about 2.5%. Sterling, for its part, it strengthens up 0.4%, cable at 124 after stronger UK inflation than expected, 3.2% versus 3.1%. Oops, that gets awkward for Bailey, who yesterday was talking about cuts. S&P also a rebound, up 0.2%. But the trend this month has been a sell-off in equities. Finally, it feels like U.S. stocks have succumbed to higher yields and geopolitical fears. So far this month, which keep in mind, has only been 2.5 weeks, the S&P is down nearly 4%. If it holds on to these losses, it would be the worst monthly performance since September. Joining us now is Jay Woods, Chief Global Strategist at Freedom Capital Markets, who always has an eye on the charts. Jay, great to see you. Thanks for coming in this morning. So you write, this is the first time we didn't buy the dip all year. Why is this dip different from others?
Well, this dip is different. You said it's the worst sell-off since September. And what happened in September? The 10-year started rallying towards 5%, and it accelerated. What's happening now? The 10-year is starting to rise towards 5%. It's accelerated, but where were we then? Where are we now? The S&P was just under 4,500. Now we're still above 5,000. So this higher for longer narrative is being digested. We're holding levels, but this pullback, I know there are geopolitical headlines, and we're always going to have a headline for why we sell off. But let's think where we came. We just had 111 days above the 50-day moving average. We're 2 days under. Okay, these things happen. That was the 12th longest streak since 1940. That's pretty impressive, longest since 2018. 2 quarters of 10% growth in the S&P 500. So pullbacks are normal, they're healthy, and this could be just a garden variety pullback, or it could be something more with the headlines. But I think the focus is on earnings, and right now, the earnings that we've seen, especially in the financials, they're not moving the needle higher, but they have been positive. We're seeing growth, so there are some positives here, and this could be a buy the dip over the long term, but right now, no, we're not buying that.
At what point do you get comfortable buying the dip? Because it's not exactly a full-scale de-risking. Jay, we're still just less than 4% from the all-time highs. That's by no means bad. So at what point do you say, okay, I can jump in, I can buy this thing?
Yeah, well, I think you want to nibble now. I mean, look at where they're buying stocks during this dip. Those magnificent stocks, the magnificent 5 stocks that have continued to do well.
Pick your number.
Yeah, I know. It depends what day it is. But right now, you have the NVIDIAs, the Amazon, the Googles, the Microsofts that are continuing to do well, and they're doing well in the face of, you know, some negative headlines. it's your favorites, the small caps that just
Thank you,
can't
Jay.
get off the carpet. I know, and I came in here, I loved it, but given how rate sensitive they are, technically they never followed through, and we're going to chop for a while in your favorite little small caps.
You're breaking my heart, Jay.
I know.
But I'll forgive you.
Okay.
Going back to the banks,
Yes.
it is remarkable, though, because when you see bank earnings that are fine, they're good, if anything, and they just get so punished. J.P. Morgan, its worst sell-off since 2020 after net interest income that wasn't upgraded. Bank of America fell 3.5% yesterday, its worst day in nearly a year because of higher expenses. Overall, the earnings were okay, but these little one-offs are really getting punished by the market.
Yeah, we're focused on the negatives with so many positives in it, but look at JP Morgan. The stock had a tremendous run going into earnings. For that to take the next leg higher, it was going to take something extraordinary, and Jamie Dimon's not going to give you this rosy picture, everything's fine. He's, always looking at worst case scenarios, and that's what leaders do. They want to see, okay, we did well, we're not going to spike the football, but what's going to be the next one? And then Goldman Sachs. Goldman Sachs crushed it this quarter. Those metrics, Morgan Stanley crushed it, but price action isn't taking us higher. And as a technician, that's what has me concerned, because the XLF made this full roundabout, broke out, and it looked like it was going to be on its way higher. It was up over 10% in the first quarter. Historically, when the XLF is up over 10%, it's up 15 out of its 25 times as an index, the ETF. It's finished higher on average by 21%. Those years it's higher. So it has room to run. It just didn't get that catalyst this time. And that's what's got me concerned, because we didn't see the large cap financials take us that next leg higher. So we pulled back, and, buyable dips. Yeah, it's always scary when you're living through it. Oh, no, maybe this isn't your normal 5% correction. But if you look at the big picture, secular bull market, the higher for longer narrative is holding on. I think this is a buyable dip, and when we hit 5,000, 5,001 is a 5% retracement. I think that's where you're going to see people come back into this market. So I think we're going to go sideways for a little while, and people don't realize sideways is a direction, and you can make some money trading those sideways chops. But I was hoping the financials would take us higher. I'm watching the KRE. That's at its 200-day moving average, and it's an interesting thing as they report earnings this week and later next.
I thought earnings would be the thing that saves us. That sure, it's higher rates, but as long as the growth story is okay, we're okay.
Yeah.
Is that narrative challenged at the moment?
It's not challenged. It's a narrative that doesn't always work out. You can have great earnings. I go back and just look at the poster child, NVIDIA. NVIDIA back, I think it was last August, had its best quarter ever. The stock gapped up and reversed. It closed on its lows and then went sideways for 5 months. Their earnings have been fine. They've been spectacular, but it got a little tired. And right now, this market's a little tired. The broadening out theme is kind of slowing down because of those higher rates. Jay Powell threw some cold water on us yesterday. Almost put me to sleep just now listening to it going into this.
Jay, that's sacrilege. You can't say Powell's putting you to sleep. You got to be gripped onto every word.
He's just got to bring a little more life or pep to the conversation. But we'll see. To me, the PCE, you mentioned Bailey said there could be a rate cut. I think June isn't off the table yet, because they focus on that number, and believe it or not, I believe they're looking for one cut before the election cycle really takes place, get it back to 5%. That last hike probably wasn't necessary, although three straight months of CPI ticking up slowly, that's not what we need to see. But the PCE has remained slow and steady and in the right direction. So that will be the one, besides the individual earnings, to watch coming up next week.
Jay, you said a little bit of the quiet thing that we're not really allowed to say out loud, but I kind of want to get into it. You said they're likely to cut before the U.S. election.
Yeah.
Do you think that they're not willing to start a cutting cycle during the U.S. election? Is there a political element to when they finally start to cut?
Well, they'll never admit there's a political element, but of course, during election season, you kind of want to remain neutral so you don't have talking points on either side. And if you're going to do it, I think June is the time to do it. There really is no reason for them to cut. Even Powell admitted that so much yesterday. But if things can stabilize, maybe they just throw that trial balloon, a quarter-point cut, see what happens, and go from there, because the next big cut could be November, and that's election day. So, I think you know, they're not going to come out and say that, but we talk and, you know, on the floor and you know, up on the desk, and these are things that people
Well,
watch.
you're not the only one saying it, Jay, so very fair enough to bring it up. Jay, we're going to have to end it there. Thank you so much for joining us this morning. Always appreciate your time. Jay Woods of Freedom Capital Markets. Okay, coming up, the tech story. Shares of ASML getting hit, slower demand for the maker of chip-making equipment. We're going to have more on that next.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Shares of ASML are tumbling this morning in the European trade. First quarter earnings missed estimates, and it also hurt the analyst outlook for 2025. Shares down some 4%. For more, let's bring in Bloomberg's Chan Koch, who joins us now from Amsterdam. Chan, what happened? I thought this was the quarter for AI. This was the thing for demand. If you're going to be building AI chips, you need ASML in your life. So what disappointed?
Well, it's fair to say it's a disappointing quarter for ASML. Shares dropped 6.4%, and they're still down 4%. Investors are not very happy because there's a big miss in its order intake in the first quarter, and that's led by a big drop in the demand for ASML's most advanced extreme ultraviolet or EUV machines. EUV sales in the quarter beat estimates, but orders for new machines plunged to 600 million euros in the first quarter from 5.6 billion euros in the previous quarter. And that's due to the downturn in the chip industry.
So China, this surprised me. China is still ASML's biggest market, even after you take into account all the export controls. So how much of this had to do with China slowdown, or on the other hand, is Chinese demand still strong?
Yeah, so the U.S.-led export controls on ASML sales to China kicked in on January 1. And we see a little bit of an impact of those measures on ASML sales to China. The sales dropped by 270 million euros in the first quarter from the previous quarter. But China is, as you said, still the biggest market for ASML, and that's due to a drop in the share of other markets. This shows that Chinese chip makers are still buying older ASML machines as China tries to take over the market for kind of mature chips. It also shows that other chip makers like TSMC and Samsung are not rushing to buy equipment from ASML.
Finally, not lots of time here, but ASML, they themselves were optimistic about later this year and into 2025. Analysts seem to feel otherwise. Stifel, for example, saying that the low order intake could put 2025 sales into question. Why is there this divide between what analysts say and what the company is saying?
Well, the company is basically saying that a lot of fabs are still being built around the world, and the constructions need to be completed before they can order from ASML. Huge subsidies are being made available around the world, in Taiwan, in South Korea, in the US, to build facilities as countries seek to kind of safeguard chip supplies. And a lot of these fabs will be ready for orders from the second half of the year. So ASML really expects to take off from next year in line with the industry's continued recovery from the downturn.
All right, John, thank you very much. John Koch there joining us from Amsterdam to the finance sector. Morgan Stanley will cut about 50 investment banking jobs in Asia. That includes its biggest round of layoffs in China in years. Let's bring in Tom Metcalf, our Bloomberg finance editor. Tom, what do we know about these job cuts, and what does that tell us about Morgan Stanley's venture into China and their attempts to grow wealth management there?
Yeah, it's a really fascinating dynamic. So as you say, about 50 job cuts in the region, and 40 of those or so are going to be effectively in China and Hong Kong, so Morgan Stanley's biggest market. And what it just really underlines is just what a difficult spot that market in particular is in. So obviously there's been the real estate troubles, the economy, at least by sort of China standards, has been relatively sluggish. And, you know, a lot of big Wall Street banks have, you know, bet a lot on kind of building out there. And it looks like, you know, for Morgan Stanley, they're retrenching a bit. You know, they're not saying, hey, we're retreating out of China, but particularly on the deal-making side, you know, these are big, big cuts. You know, something like 400 deal makers in total in the region. So you're looking at, you know, a big old chunk of people to leave with 50 going.
Well, we also heard from Morgan Stanley yesterday. These were a strong set of earnings when it comes to wealth management, when it comes to trading. Does this run counter to that? Does this run counter to this narrative that their wealth management division is running at pace if there's some pullback in China?
Well, I think the most interesting thing is one of the things the CEO said yesterday was investment banking, you know, he sees that as a really big bright spot. It was shown in the results. And going forward, he expects there to be a big recovery there. So for me, it's fascinating, you know, specifically in China, that's obviously not what they're seeing or expecting to be the case. So there's a little bit of that sort of divergence there between, you know, Morgan Stanley probably talking about, you know, maybe the US market more than anything on the deal-making front being very strong. But basically taking a very sort of, taking a step back, looking at China and going, no, we've, you know, overexpanded there a bit, we need to cut back. So two different things going on there. And yeah, as you say, a strong set of results. So it's interesting, you know, to follow up that with some news of cuts in China.
Yeah, and also the news before that of some scrutiny over money laundering. It's like a good news sandwich, bad on the ends, good in terms of earning in the center. But for earnings as a whole, these banks are being treated very differently by this market. All it takes is one little miss. From JP Morgan, it's not upgrading their NII. For Bank of America, it's higher expenses and charge-offs, and that's enough for these shares to get punished. We're talking about to Jay Woods about this, the willingness of the market to punish these stocks. What do you make of that? The bumpiness, the lumpiness of how these banking stocks have performed this earnings season?
Yeah, exactly. It's been fascinating watching the US banks report, right? And you've really had that range. You know, Goldman Sachs did very well. Obviously, Morgan Stanley similarly well received. But yeah, no, there's just this big discrepancy. And you know, I think it's kind of on a case by case. You look at JP Morgan, how well its stocks performed and how, you know, that kind of incredible run of earnings it had. So perhaps not too surprising they're going to be pulling back a little bit when they do miss on certain things. And I think the big thing is, you know, as you look at each bank, like what are investors focusing on? So for Goldman, look, that bet on the capital markets business makes a lot of sense for that particular firm. It's really paid off this quarter. JP Morgan, people are probably more closely looking at that NAI figure, and that is just a tougher environment for banks generally. And then you had Bank of America yesterday as well, right? And there, again, charge-offs, stuff like that, just giving people a bit of cause for concern in some cases.
Tom, really appreciate it. That is Bloomberg's Tom Metcalf. Okay, speaking of banking, JP Morgan CEO Jamie Dimon has been laying out his vision for the future of money in an AI world. Bloomberg Originals spoke exclusively with Dimon to kick off the circuit with Emily Chang's second season. She asked him about the opportunities and risks ahead.
The best thing is be prepared for any business. When you think about risk, think about things that can go terribly wrong. Can you survive them? You know, it could be technology, it could be government regulations, it could be literally the weather. If you're a restaurant, you know, that might close you down. If you lose this week's business, you're out of business, you don't have enough cash. So you should think all that through.
Bill Gates once said, banking is necessary, banks are not. To what extent could AI or fintech replace traditional banks?
So I think, first of all, I remember him saying banks are dinosaurs. I spoke to him about it in 1997, and he was dead wrong. He'd probably agree to that. But he's not wrong that technology changes everything. And if anyone is complacent or arrogant or think that because you have a big position today, you can have a big position tomorrow, that's a mistake. But then you have to define what is banking. Someone's going to have to hold the money. Someone's going to have to move the money. Someone's going to have to raise the money. Someone's going to have to do research, around money. Those services will still be around. And, hopefully we're doing it and using a lot of tech to do a better job at it. But I've always thought it's very possible that some tech thing, disintermediates a piece of that. And I've been writing about, big tech going to our business. We got fintech, but we also have big tech. And they will embed payment systems in there. Some are going to white label banks, kind of what Apple did. They have the right to do that. I'm not against that. I would be against unfair use of their position to dominate us in a business.
Well, Apple is going deeper into financial services. Do you worry about the Bank of Apple?
Well, we're going to compete. So they have a tough competitor, but they hold money, move money. Yeah, they're a form of a competitor. We also partner with them, but I'm very used to partnering and competing with lots of people. So,
existential threat?
I don't think it's an existential threat, but I think if we were complacent about it, yes.
You can watch the full episode of The Circuit with Emily Chang tonight. That airs at 6 p.m. ET in New York on Bloomberg TV, or stream at 8 p.m. ET on Bloomberg Originals. The strength of the dollar finally starting to wane. It had been 5 days of a stronger dollar, most of G10 currencies. That changes this morning after yesterday getting a boost from Jay Powell and from Jefferson saying that it might be higher for longer. That is the dollar down about 0.2%. But if we can get up the euro and sterling this morning, both of them stronger. A couple things happening here. UK inflation stronger than expected, 3.2%. The estimate was for 3.1%. Euro, this is interesting. Lagarde talking yesterday, and still this narrative, this idea that they can cut soon. They're going through to that path. She says, we're heading towards a moment where we have to moderate the restrictive policy that we have. However, Lagarde did say that the ECB needed to pay attention to the changes in exchange rates. Of course, weaker euro as a result of them cutting before the Fed. We spoke about this last week with various guests, that it might cause this chain reaction, as Ludo from Allianz says, this chain reaction where a market overreacts. So it is something that Lagarde clearly is paying attention to, even if she says they are not dependent on the Fed. Bailey also said yesterday, talking at the IMF, that they can indeed be cutting before the Fed, but will the data let them do so? At this moment, it seems not. So cable at 124, euro at 106 as the Bloomberg dollar spot falls 0.2%. Okay, coming up, we're going to get you set up for your trading day, a look at some of the market moving events here on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Danny Berger. Managed Cranny is off today. Let's get you set up for your trading day on this Wednesday. The Fed will be issuing its beige book. That comes out at 2 p.m. Eastern. Then more Fed speak. Cleveland Fed President Loretta Mester will speak at 5:30 p.m. in Ohio. And the Boeing whistleblower testifies on Capitol Hill after the plane maker defended against allegations. And remember, we're also going to have Biden in Pittsburgh at the same time, too. We had breaking news at the top of the hour of considering more tariffs against Chinese steel and aluminum. In terms of the individual stocks moving before the opening bell, United Airlines shares are up. They had forecast better than expected profit this quarter, using some concerns about Boeing. And, of course, the drama there continues today. Applied Materials, they are falling after that ASML orders took a hit and a slowdown for its machines. Finally, Coinbase, that is up in the pre-market trade, some 1%. Crypto.com is in the middle of a hiring drive and showing improved employment outlooks in the sector. Finally, for this overall market, it is finally tempting some buyers to jump in. 5% on the front end. Eases down. We're down by about 3.7 basis points. It really seemed like Jefferson yesterday talking about higher for longer was the fuel for a bond market sell-off. We're still around November highs for this bond market, for the 10-year yield at 4.63%. We moved lower by 3 basis points this morning. JP Morgan's client survey did show that investors net long by the most in 3 weeks as of Monday. So the buyers are coming back. Is it enough for a turnaround? That's it for the Bloomberg Brief. Surveillance, that's up next.
Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
DOJ or other authorities
could face bigger challenges.
It was going to keep Rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
The U.S. is leading. And this is one reason we remain overweight U.S. stocks.
The U.S. dominates in relative space. It dominates almost regardless of what the global scenario is.
I think that we are in the midst of a game changer on technology.
The bar for earnings to surprise to the upside has risen.
For now, the economy is certainly riding the wave of the increase in the stock market.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, and good morning for our audience worldwide. This is Bloomberg Surveillance. Things settling down over the last 24 hours, just a little bit as we work our way through the middle of the trading week. Equities a little firmer, the bond market a little calmer, if we can call this bond market calm. Breaking through some interesting levels once again yesterday, through 5% for the second time in about a week. We back away. We're down 4 basis points at 494.92. On a 10-year, down 3 basis points at 463.66. Lisa's been talking about this for a while. Are we up here for the right reasons or the wrong reasons? Let's turn to the Fund Manager Survey from Bank of America. The most bullish FMS since January 2022. The biggest jump in global growth optimism since May 2020. And Lisa, a record jump in allocation to commodities.
So we've been saying, are you full bull? And this Fund Manager Survey has the headline, pretty fully bully. It also talks about, as you talked about, the most overweight commodities going back, the record jump in respect to allocation of commodities. This is the setup to yesterday and the day before. This is the setup to Jay Powell coming out and saying, it's been a little bit disappointing for us. We might have to wait a little bit longer. And the reason why people are seeing the potential for some sort of pullback, but nothing fundamentally shaking the confidence in this market.
The quote of yesterday for me, Bramo, and I'm not sure if you agree, perhaps you do, did not come from Fed Chair Jay Powell. Actually came from the Vice Chair, Philip Jefferson. And I'll share this quote with you now. My baseline outlook continues to be that inflation will decline further with, and this is the important line, with the policy rate held steady at its current level, at the current level. Our old friend TK would say extending the x-axis. The emphasis for them right now is on time, and it's going to take longer.
And right now what you're seeing in markets is an extension. It is time. Remember how yesterday we were talking about what if Fed Chair Powell came out and said, I'm hopeful, I'm not necessarily confident. That was the subtext here, that essentially they are hopeful, but they are not confident, which is the reason why they're going to hold it longer and hold it higher for longer. And right now the market's trying to come to terms with that.
I got that sense as well when he said the recent data hasn't given us the greater confidence, but we are expecting the confidence to come with more data. John, you mentioned the timeline. which makes me think that this is very political. Because if they need more time, there's only a certain amount of data points left and meetings left before they could cut, before it becomes unfathomable in an election year.
Well, let's talk about the politics and the election year. This just moments ago, a little bit early this morning, President Joe Biden calling for higher tariffs on Chinese steel. This from Lael Brainerd, the NEC director. The president understands we must invest in American manufacturing, but we also have to protect those investments and those workers from unfair exports associated with, guess what, China's industrial overcapacity. Where is the president today? Where is he?
President's in Pittsburgh.
There we go. And what's he going to be talking about?
Tariffs on Chinese tariffs on steel.
Perfect timing.
Because he's talking to steel workers. You have to think when you see a policy like this, given how much of this kind of steel is in the marketplace, it's less than 1% of demand in the United States. So we're talking a little over $1 billion last year, that they probably looked at what is the president doing gearing up for the election. Pennsylvania is a critical state. Trump and Biden have both won it in the elections that they won. And then you have to think they worked backwards. That's the event. What's the policy to appeal to this electorate?
So from the market's perspective, what do you read into this? Is it politics or is it markets? Is it inflation or is it containment of China and the export of goods? Which is it? Because if it's inflation, then you're not going to see tariffs like this go through in any kind of meaningful way that are actually going to be enforced. If it is really this idea of the economic competition between the U.S. and China, well, then you can expect stickier inflation. And this is the difficulty that the market's been having trying to reconcile some of these messages.
It's neither of them. It is purely politics.
It's purely politics. It's dominated and driven by exactly that, but it will have economic consequences. And a surprise, we're going down to Washington, D.C. a few hours from now, actually, for the IMF World Bank spring meetings. And this isn't a bigger issue. Who's down there in Washington right now at the World Bank, the IMF, talking up the benefits of free trade anymore? It just feels like everyone is thrown in on the towel on all of that just to get re-elected, because they know if they start talking about doing anything else, they will not win an election come November.
We also have been talking about this, though. How does the U.S. and the rest of the Western complex compete with the threat of China exporting cheap goods in a material way? Not only that, but how do they compete with the idea that China has unilaterally been funding a lot of other countries to exert its influence? We're going down to the World Bank, to the IMF, where they're going to be talking about joint cooperation at a time where China's going its own way. And China is the one country that nobody talks about. So I'm very curious to see how people address how this is going to shake out and what they're doing to potentially either get them on board or come up with some sort of cohesive strategy on the other side.
There is very little cooperation, and we'll try and talk about it through the week. Equity futures right now on the S&P 500 firmer by 0.4%. There's a little bit of a lift here. Yields are lower by 3 basis points, 463.66 on a 10-year. Crude backing away, down 1 full percentage point, 84.50 on WTI. Coming up this hour, we'll catch up with Lee Ferridge of State Street as Chair Powell puts rate cuts on ice. Sheila Kaiolu of Jefferies with a Boeing whistleblower set to testify on Capitol Hill. And we'll catch up with Ben Callow of Baird on Tesla's management shake-up. We begin with our top story. Fed Chair Jay Powell putting 5% yields back in play, admitting cuts will have to wait. Lee Ferridge of State Street saying this: if the Fed has not started to ease by July, we do not believe they will be able to cut in September. It will be too close to the election. The time frame for cuts is therefore closing sharply. Lee Ferridge joins us now for more. Lee, let's get straight to that argument. Why do you think the election matters that much?
Well, I think, look, if we were in the midst of a cutting cycle or a hiking cycle, then I think September is a perfectly live meeting. I think being within sort of 6 weeks of the election, you don't want to start a new cycle there. And this is why I'm saying, look, if they don't move in July, I don't think you start a cutting cycle in September, and that means that then we go to the November meeting, which is actually the day after the election. That's why September really, for me, is very difficult for them to move.
Lee, it looks like the bond market's adjusted to that reality. We breached 5% at the front end of the curve in yesterday's session for the second time in about a week. The 10-year's getting closer and closer to 470. We're trying to figure out if they're up for the wrong reasons or the right reasons. If yields are up here because growth is really solid or inflation is resurgent, or both, and what that ultimately means for the equity market. How much competition is this bond market providing against stocks now?
It's starting to be competition. I think, to answer your question, I think 2 years are up there because of growth. I think 10 years are up here because we're getting worried about inflation. You only got to look at break evens. You can see 2 and 5 year have been moving up over the last couple of weeks as well. So, look, I think with the bond market, 2s and 10s are moving for maybe different reasons. But 10-year yields up here, we saw, look, we get towards above 4 3/4, 5%, then it becomes, a very real challenge for the equity market. Look, I still think as long as the curve is inverted, as long as the market still believes they're about to embark on a series of rate cuts, then equities can hold in. And at the moment, that's where we are. We've extended and pretended so far this year. We did have March, the first start, that's the start date of the cutting. Then we went to June, and now we're pushing that back again. But the important thing is the market still believes we are going to enter an easing cycle. As long as that's the narrative, equities and risk generally carrying FX, they can all carry on trading as we have been. Maybe it gets a little bit more challenging from here. I think it does. But overall, I still think the risk environment is positive so long as the market believes cuts are coming.
Lee, how much conviction do you have that we're actually going to embark on some sort of rate cutting cycle? How much conviction do you have to get behind a risk on kind of feel at a time where things are looking a little shaky?
Yeah, my conviction levels on the whole cutting cycle have been limited for a while. Look, I worry that if Chair Powell doesn't get a cut in before July, I'm not sure we can get one this year. I worry about base effects in the second half of this year. I worry about the shelter component of CPI and PC in the second half of this year. House prices are going back up in the US. PC, shelter, and CPI owners equivalent tend to lag house prices by about 12 months. So that implies second half of the year, they start moving back up. Base effects generally are not supportive in the second half of the year. So the real risk is the second half of this year, inflation actually starts to move back up again. It hasn't come down as they hoped for in the first quarter when base effects were positive. And this is going to create a problem. So look, my confidence levels that we are about to enter a really prolonged cutting cycle are quite low, actually. Now, the market isn't there yet. The market still believes that we are, and that's why I say risk can hold in for now. But I think end of Q2, early Q3 is really when I'm starting to worry that the market's going to have some sort of rethink.
I spent a lot of time last night thinking about the dollar, especially in light of just what this means for other rate cutting cycles around the world. How close are we to a strong dollar starting to break things?
I think we're there. I mean, I think, I've been amazed. One of the things I'm most amazed about this year is the market's reluctance to price divergence. But we have a huge macro divergence, probably the biggest macro divergence in G10 that we've seen in decades. But the interest rate market has been very reluctant to price other central banks cutting before the Fed. It has no choice now. The S&P already went. The ECB have pretty much nailed on the June move, whereas Chair Powell yesterday obviously pretty much took that off for the Fed. So the market's almost been forced into pricing other central banks cutting before the Fed. And that's fine because FX markets are still not moving that much. You look at where the euro is now, 106.5. Look, we're pretty much the middle of the range we've been in for 12 months or so. It's not as if we're at extremes in FX. Yen aside, yen is a different case. But for the rest of the G10, we're not really at extremes. And so therefore, other central banks should be confident to go ahead and cut rates as they see fit. Look, if the euro is getting down below parity, then yeah, maybe we should worry. If sterling is getting down to 110, maybe we should worry. But that's not where we are right now.
We also heard from Andrew Bailey yesterday of the Bank of England. Of course, he's going to be at the IMF spring meetings. He pretty much implied that they're ready to go before the United States. Is that your base case?
Yes, it is. I mean, this is again, this is why we have a negative view on sterling against the dollar, because when you look at what the rates market's got pricing, really the first Bank of England cut is September. Pretty much the same as where the Fed are in terms of rates pricing. That makes no sense to me. UK growth is negative. Okay, US growth is almost twice trend growth. We're at 3.1%, going to be around 3% in the first quarter. Very, very different economies right now. UK inflation, even though it's a little bit higher than expected this morning, is now below US inflation headline for the first time since 2022. We are moving in different directions. The US is growing above trend, the UK is in recession. The Bank of England should be cutting before the Fed. There is no doubt about it. And yet the market still doesn't have that price. And I think that has to be pulled forward, and that's going to see sterling weaken. I think you could also see euro sterling higher in that scenario because we pull forward the ECB, but not the Bank of England in the same way.
Well, let's talk about some levels. You mentioned some. You talked about 110 on cable, parity on euro dollar. Lee, are you actively looking for those kind of levels to come back again?
No, not yet. Look, I mean, I think... Yeah, I got caught out with sort of being too bullish on the dollar last year. We got down to sort of 105.5 on the euro, and I thought we'd go further, and then we just reversed. Look, I think the dollar over the next couple of months, it's going to struggle to make gains across the board because we've now taken so much out of the Fed this year. It's hard to take a lot more out in the next month or two. Maybe we can in Q3, as I said. I think, then things could change quite dramatically. But right now, you're not going to see it. So it's going to be more idiosyncratic moves for the dollar, I think, in Q2, where we add rate cuts in elsewhere. So sterling is an obvious one. But 110 is a long way on that basis. No, I think we can get down to 120. I think on euro, we could maybe get down to the 103 level, quite away from here, quite honestly, and given the ranges we've been used to over the last year or so, some pretty big moves, but not maybe to the extremes you're talking about. It's possible if the others, the other economies continue to weaken, the central banks get more aggressive, but they seem very wary of outcutting the Fed by too much, and that might contain some of the FX moves, but it's very hard to look beyond the dollar. Very hard to look beyond the dollar within G10 right now.
Lee, enjoyed this. It's great to catch up, buddy, as always. Lee Ferridge there of State Street. Bramo, well done for bringing up foreign exchange because we've seen some big moves so far here today. And people like Lee think we might see some bigger ones. I think yesterday closing out on DXY at least, 106 handle, 6 days of dollar strength, longest stretch going back to September last year.
We talked about who cares most. Who does this sort of tie the hands of most? The Bank of Japan, the ECB, or I'll add this in, the People's Bank of China. Take a look at the yuan weakening and the fact that they are basically avoiding potentially cutting rates even more to avoid further depreciation of their currency. This is a massive issue for the other central banks, and it's got to be front and center.
What do you do if you're worried about tariffs? Weaken the currency, don't you?
Well, okay, so this is one thing, right? You weaken the currency, and then all of a sudden you're exporting even more cheap goods. It gets hairy when you're starting to think about it.
I'm not saying that's what we're playing right now. I'm just saying it's an interesting dance taking place.
It could. That's sort of what Mohammed El-Arian was leaning at.
Right to bring it up. Dollar strength, big issue at the moment. Just a little weaker on the session. Let's give an update on stories elsewhere. Let's get to your Bloomberg brief. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. ASML shares are lower in Amsterdam trading. Europe's most valuable technology firm posted new orders that fell short of analyst estimates. It was hurt by a downturn in demand for its most advanced machines needed to make high-end chips. ASML said it's expecting weaker than expected sales in the second quarter before demand starts to pick up. LVMH sales growth slowed at the start of the year. Revenue in its fashion and leather goods unit, which includes Dior and Louis Vuitton, grew just 2% in the first quarter compared to 18% growth a year ago. But shares are rising in Paris, trading amid relief from investors who feared results would be worse due to a worldwide slowdown in demand for luxury goods. And record rainfall in Dubai led to flights being diverted and cars being left stranded on flooded roads. The United Arab Emirates experienced its heaviest downpour since records began back in 1949. That's according to Dubai's media office. The government told its employees to work from home today and urged private employers to do the same. Schools have been directed to remain closed. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. So they've been seeding the clouds, is that right? They've been trying to make it rain more aggressively.
Wait, how are you coming up with a conspiracy theory about this? Is that really what happened?
That's not a conspiracy theory. That's what's been happening in Dubai.
Wait, so this is their sort of own doing?
I don't know how much of this is their own doing, but they've certainly been seeding the clouds. That's what they've been trying to do. They've been trying to generate more rainfall. And they clearly don't have the drainage for the rainfall they've been getting, which is obviously problematic based on what's happening at Dubai Airport.
Man versus cloud.
Yeah,
we'll continue.
I know.
Coming up next.
You should read about it. Anyway.
I will.
Okay.
It's a desert, so they need this water. But
up next on the program, Boeing under scrutiny on Capitol Hill.
Without an absolute reputation for safety and consistency, you simply can't compete, and that's why everybody's worried about Boeing.
That conversation up next, live from New York City this morning. Good morning.
as elections kick off with a focus on the economy, social divisions, and climate change actions that will influence the global story. Bloomberg is live on location with the latest updates from the world's largest democracy. Coverage begins April 19th.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I love Bramos. Spent the whole commercial break reading about cloud seeding in Dubai. What did you learn?
It's fascinating. I mean, this is basically one of the contentions. Some people are saying that they might have conducted cloud seeding. They're saying absolutely they did not operate cloud seeding right before the torrential rains. But this is a real thing.
I'm surprised it hasn't been a bigger piece in the news cycle over the last day or so. I am surprised.
They've been cloud seeding since 2002, yet they haven't put the right drains in case cloud seeding actually worked. I mean, look at the airport.
It's amazing. It's amazing the amount of flights that have been cancelled as well. If you're over there, I hope you're doing okay. Equity futures on the S&P 500 positive by 0.4%. Small bounce. Yields are lower by 3 basis points on the 10-year 463.66. Under surveillance this morning. Boeing under scrutiny on Capitol Hill.
Of course, everybody in America is worried about what happened. Without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing. We've got to get Boeing back to the point where it produces an impeccable product.
Here's the latest this morning. The Senate holding 2 hearings on whistleblower claims around Boeing's safety culture. Those claims prompting ongoing federal investigations, as well as a criminal probe by the Justice Department. The whistleblower is set to testify, but Boeing officials won't be present at either hearing. Present now is Sheila Kahyaoglu of Jefferies. Sheila, let's get into it. The claims, the allegations coming from whistleblowers, how serious are they? What's the big one for you?
With the 787 whistleblower, you know, that's new news since the CEO has announced that he's stepping down at the end of the year. The 787 has been a fairly safe aircraft. What we track is production of the aircraft on a monthly basis and deliveries, and what we're seeing is at about a rate of 5 a month. So we feel a lot more confident in the 787, just given the track record. Also, bear in mind, the 787 at peak did 14 a month, is slated to go 10 a month. The 737 at peak was supposed to go to 50 a month. So just a lot more pressure on the production line to churn up those aircraft out at the door. Of course, the 787 is a bigger aircraft, but, you know, it just the pressure of the volume really hurts.
Are we going to learn something today, or is this theater?
I think it is a little bit of theater, especially because you have had this management overhaul in place and the board changing as well. I do think it is a little bit of theater. There was the NTSB with the Senate yesterday. We didn't learn anything really new out of it, whether what happened on the Alaska flight or Boeing's safety culture. So I'll wait to see what happens today. But given that there's no Boeing executives, I don't think we'll hear much new.
Is that news in and of itself? The fact that we're so far after this happened, that we've really had so many questions, there have been more incidents, there have been lost orders, there have been increasing delays at certain airplanes. How much is that surprising that we don't have more answers, especially as the Department of Justice operates some sort of criminal probe?
Yeah, I think the FAA really has to focus on bringing safety back to Boeing and also the public perception. Everyone asks what's going on with Boeing. Kayak has a search function where you could choose what type of aircraft you're on. I guess I get endless Bloombergs from colleagues of, is it safe to fly this aircraft? I'm like, yes, it's completely safe. So I think the public perception is what we need to change now. And the new CEO, when they're announced, and no one knows how far that search is, has a lot of work to do, whether it's the safety culture, but also new technology, bringing that to Boeing and just overhauling the culture and also cleaning up the production lines a bit.
With the NTSB yesterday on Capitol Hill, do they see any evidence that things are moving in the right direction for Boeing?
To be honest, it was a bit backwards looking. We talked about the older the prior incidents that happened on the MAX. Very little was given on Alaska. So I think we're going to wait to see what happens with the FAA audit is now complete and what happens with the next steps. But that brings you to the summertime period.
and we should probably see a new CEO in place by then. So I think Boeing is sort of in this purgatory right now where the FAA is still on top of them. We're only producing about 17 737s a month. We're supposed to be at 38. So we're at this very low production, and that brings us to airlines. In a way, capacity is very tight in the U.S. domestic market.
Well, two things to talk about. Let's talk about the CEO search, and then we can get to the prospect of deliveries picking up anytime soon. How big is the potential talent pool for the CEO of Boeing? Where do you find them? If you're a recruiter, who do you call?
The most popular question investors ask us every day. I think there's only a select few individuals for the job. It seems overall sentiment is for someone new, an outsider. We've seen it happen at GE 6 years ago. Larry Culp took over with a fresh set of eyes, dismantled GE, and GE Aerospace started trading as a public company at the start of April.
Is that the number we're dialing, 1-800-GE, Larry Culp extension?
It kind of is.
Yeah.
I think given his history at GE, he brings, a strong background to it. There are a number of people on the board, and there's also, of course, the other aerospace and defense executives as well.
Might be a few quarters until we get him. If we get him, I want to work out what happens with deliveries in between. Are we just going to sit at these levels and not pick up?
We've cut our delivery forecast from about 500 total aircraft, including, for the MAX, to 400. But the way we're trending right now, with only a handful of deliveries to start the year, you're going to see a lot more pressure on deliveries. And without, depending on when a new CEO is announced, I can't imagine he's going to pick that rate back up the first moment he steps in. What they're probably going to do is say, our $10 billion free cash flow target for 25-26 is out the door. We don't care about rate. We're not going to talk about rate. We're going to focus on quality. And once we hit those, we'll start increasing rate.
Does that mean we're going to be flying a lot of old planes just in the meantime because they can't get the new ones?
With the ashtrays in? Those planes?
I actually went to the TWA hotel, and you can see the old one.
When you get on a plane and the ashtray's in there?
There's an ashtray. It's actually been made into a bar, but let's carry on. It's really cool, actually. Highly recommend.
I was speaking to the United CFO last night, and Michael Leskinen was talking about United was expecting a lot of new planes this year, but they're not getting them. So they're positioned to be a much bigger airline than they are. They have the headcount in place, but they're not getting them. They have to fly the older planes while they're trying to put up a premium product. So they're focusing on better Wi-Fi, better interiors, better food quality, but keeping costs down. So I think for now, the consumer is in a tight spot. And if you think about 100 aircraft removed out of Boeing's forecast to start the year, that's a big capacity reduction, 2.5 points of capacity out of the U.S. domestic market. That could translate into a big price momentum for the U.S. airlines, which have been suffering. U.S. domestic pricing essentially was flat year on year in 2023. Q1 saw some signs of improvement, the inflection we were looking for, but that the airlines hadn't priced in for. So in a way, the way to play this Boeing issue is through an airline and an aftermarket shop like a GE and a HEICO, while Boeing keeps their deliveries low. But it's bad for the consumer overall.
Given how this conversation's gone, all the more impressive that United did what they did after the bell yesterday. I think the stock is higher at the pre-market, Bramo, by 5%.
They didn't lose as much money as they can think. I'm just thinking, what are we going to say? Free Wi-Fi, ceiling optional.
Better food.
Better food.
Better food, ceiling optional. Sheila, thank you.
No problem.
Sheila Kaulu of Jefferies there from New York City. This is Bloomberg.
Season 2 of The Circuit. We're walking with the titans of banking.
You guys love these meetings.
Yes, me too. And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money, you've got more leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass.
That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Things just a little bit calmer. From New York City this morning, welcome to the program. Equity futures positive by 0.4% on the Nasdaq 100, up by about 1/4%. Doing okay on a Russell. The small caps up 3/4%. The Russell, though, has been absolutely hammered off the highs of the year. I think we're down something like 7% since those highs back in March. So it's been difficult. Let's turn to the bond market. 2-year, 10-year, 30-year, breaching 5% once again in yesterday's session, then backing away. Backing away again this morning. We're down 3 basis points. 495.35 on a 10-year Lisa. 463.66.
Fed Chair Powell said the quiet part out loud, that these were not just bumps in the road. 3 of them makes him uneasy, and that basically he didn't use the bump word, just to be very clear. But he did say that it does suggest that we're not making as much progress on inflation, and maybe they might let policy take further time to work, extending the timeline.
Yeah, the emphasis on time and just reinforcing the moves we've already seen both in bonds and in foreign exchange. So switch up the board and get to FX. We'll go through some currency pairs for you. The euro back to about 106, bouncing back today. Bit of yen strength on the board, but this has been dominated by dollar strength and yen weakness over the last few weeks. Lisa, dollar yen, 154.60, and not really a peep out of the Bank of Japan, not really a peep out of the finance ministry in Japan either, because what can they do?
What are they going to do? Throw money uphill and hope that it doesn't come down? I mean, at a certain point, people are talking about 160 being a testing point for them because they cannot counter a strong dollar, given that they are not raising rates materially from here. What I keep asking is, when does the dollar break something? Because right now we keep seeing strong dollar at the same time that the rest of the world wants to start a rate-cutting cycle. How does that work if they're trying to support their economies?
I want to turn to sterling as well, Lisa. 124.67. Cable up about 1/3%. Inflation just a little hotter, just a little bit. But the pushback we got from Lee Farage of State Street about 20 minutes ago, Lee basically said, sure, inflation was a little bit hotter this morning, but inflation is running below where inflation is in the United States. The BOE is going to have to cut soon because the growth profile is so bad, and you should be expecting a stronger dollar against the pound here and against the euro and against basically everything else in G10.
And when does that become a problem? And that's what a lot of people keep asking. When does the dollar become punitive to some of these other nations that are trying to ease, that are facing slower growth, but are going to see inflation stay hotter if they're importing it from the outside? And this is especially prevalent with oil, if oil continues to climb.
That's the currency story. Let's get some top stories for you.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
You, sir. Can we just talk about how real you think this robo-taxi effort is going to be and how